Madison Mills. This is Yahoo Finance's flagship show, The Morning Brief.
It may be a shortened trading week and day, but stocks are not taking a breather here. You're taking a look at the S&P after it closed above the 5,500 level for the first time ever on Tuesday, marking its 32nd record close of the year. The Nasdaq surpassing 20,000 for the first time ever as well. So let's get to it with the three things that you need to know for this Wednesday morning. We've got Yahoo Finance's Jared Blickery, Jennifer Schomburger, and Josh Lipton with more.
Stock futures trading close to the flat line on this shortened trading day. Job creation slowing for a third straight month. The U.S. added 150,000 new private sector jobs in June. That's below the 165,000 Wall Street expected and even below the prior month's revised levels. Pay gains for both job stayers and job changers, they slowed. Meanwhile, 238,000 people filed for new unemployment benefits last week. That is more than expected and higher than the prior reading. So the data showing some weakening in the labor market. And all of this comes ahead of Friday's big jobs report.
Fed Chair Jay Powell said Tuesday he's encouraged by the latest cooler readings on inflation, but that the central bank will need to see more evidence before cutting interest rates. Powell said that the last two inflation readings in April and May, quote, do suggest that we are getting back on a disinflationary path. The comments come days after the latest reading of the Fed's preferred inflation gauge, core PCE, rose 2.6% in May, the slowest annual gain in more than 3 years. And today, Wall Street is watching for minutes from the Fed's last meeting, which could provide clues about how policy leaders are thinking about the timing of rate cuts.
And shares of Paramount Global rallying on news of a potential merger. According to reports, production company Skydance has reached a preliminary agreement to buy Sherry Redstone's National Amusements, a controlling shareholder of Paramount. This comes after merger talks, remember, fizzled out last month. If that deal goes through, Skydance would then plan to merge with Paramount Global, which would be subject to approval by Paramount's special committee.
Our top story this morning, we're tracking stock futures. They are a little bit weaker. The latest jobs data came in weaker than expected for the month of June. This came in the form of ADP private payrolls. 150,000 jobs added last month in the private payrolls versus the 165,000 expected by the street. Now, another sign of a cooling labor market, and investors are hoping this could push the Fed to cut rates sooner rather than later. Well, I regret to inform you that the Fed's probably not going to pay too close attention to the ADP number as much as they do some of the other employment readings, notably here when we're thinking about the more cyclical and weekly jobless claims, but then also the all-important monthly jobs report, which is going to come out on Friday here and give us a little bit more of a sense of where the unemployment rate that the Fed is tracking is trending right now, too.
Yeah, it's going to be critical because continuing claims here have really surged over the course of the past 4 weeks to their highest level since November of 2021. This is also expected to continue given some seasonal factors that are going to weigh on the data. For example, automakers are set to shut down their plants for some manufacturing and maintenance updates over the summer. That could lead to a surge in those initial jobless claims moving forward as that group of individuals who might get impacted by that seasonal maintenance over the summer could seek their own initial jobless claims. That could lead to some upside surprises in that number. And this feels critical because there's been this question, and Stuart Kaiser came on and talked about this from Citi, about whether the labor market slowness that we are starting to see is indicative of a broader slowdown in this economy that could be a really negative factor for the Federal Reserve as they do try to have this Goldilocks impact on the economy. Kaiser saying that the labor market could be our sign into whether or not we are at a tipping point or if it's just casual weakness.
Yeah, looking through some of the other details of this private payrolls print, the chief economist over at ADP, Neil Richardson, had actually mentioned within this release that job growth has been solid, but not broad-based here, had it not been for a rebound in hiring in leisure and hospitality, of course, the hardest hit sector on the onset of the pandemic. If it had not been for that sector, June would have been a downbeat month, she noted. So we're actually going to have much more in that that conversation, of course, with Nayla Richardson. People can stay tuned during the 11 a.m. hour where we will have her speaking with us and giving a little bit more of her insight into this. But of course, you think across some of the different industries that saw the biggest increases. The changes by industry: construction was up by about 27,000. Services, that was up by about 15,000 for at least trade, transportation, and utilities. And we'll see exactly what this may carry over into, to some extent, into that monthly employment situation that we get on Friday as well.
Absolutely. Well, the Federal Reserve meeting minutes are going to be set to be released this afternoon after Fed Chair Powell reiterating the need for more data before the central bank can really loosen monetary policy. Here to discuss, we've got Yahoo Finance's very own Jennifer Schomburger. Jennifer.
Good morning, Maddie. Fed Chair Jay Powell said Tuesday he's encouraged by the latest cooler readings on inflation, but that the central bank needs to see more evidence that inflation is dropping before cutting interest rates. Take a listen.
I think the last reading and the one before it to in inflation, the one before it to a lesser extent, do suggest that we are getting back on a disinflationary path. We want to be more confident that inflation is moving sustainably down toward 2%. Before we start the process of reducing how tight our policy is, of loosening policy.
Powell's comments come days after the latest reading on the Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, excluding volatile food and energy prices, which showed prices rose 2.6% in May, down from 2.8% in April, marking the slowest annual gain in more than 3 years. Inflation is slowing after showing signs of stalling in the first quarter, which had caused Fed officials to look at holding rates higher for longer. Powell says the Fed wants to understand whether the levels the Fed is seeing on inflation are a true reading on what's actually happening with underlying inflation, and reiterated that the Fed can afford to be patient given a strong job market that's gradually cooling. Still, Powell's comments cheered investors looking for rate cuts later this year, with investors pricing in nearly a 60% chance of the first rate cut in September. Today, we will get minutes from the central bank's last policy meeting, though those may be a bit dated because we did not have the latest reading on the Fed's preferred inflation gauge, core PCE, at the time. Guys?
All right, Jennifer, thank you so much for joining us. We really appreciate it. Well, stocks are set to open at all-time highs after the S&P 500 closed above 5,500 for the first time in history. But taking a look at the futures right now, we are seeing the market pairing those gains that we saw earlier in the day off of some of the data that is coming out. We're also seeing moves in the Treasury space. So we're going to discuss all of that and more with our next guest, who does see more upside to come. Joining us in studio, we've got Elise Ozenba. Elise, thank you so much for joining us. I should mention you're with JP Morgan Wealth Management and a global investment strategist there. So talk to me about the data we got this morning, because we are seeing treasuries falling a little bit off of it. How big of an impact do you think that this could have?
I think the bigger picture is the primary driver of the story, right? We too are going to be hyper-focused on what we see out of the employment data come Friday. But all in all, we continue to see a labor market that remains rather robust and working in the favor of consumers with positive real wage growth. And I think we're finding ourselves in kind of this healthy slowdown that ultimately gives one of those key ingredients for the soft landing.
And so how long would that slow down kind of, if it does continue for too long, at what point does it become an unhealthy slowdown?
Yeah, the thing about labor market moves is they can happen really, really quickly, but you're not seeing that dramatic deterioration in things like unemployment yet. I think if you were to see a meaningful rise in the unemployment rate above 4%, that would maybe start to stoke some concern and maybe put that Fed put back on the table. But for now, I think all things considered, we remain confident about this rebalancing of labor supply and demand.
How does that play into your take on the equity market, given that we have hit these recent all-time highs, but there is this constant question about valuations and concentration?
We're actually pretty comfortable with valuations where they are right now. I think in an absolute sense, you of course can point to something like PE ratios and say, oh my gosh, relative to history, they are elevated. And particularly when you're comparing that to where bond yields are right now, I think it causes some pause for investors. But in an environment where inflation concerns and risks are perhaps as great as recession risks, neither of which we think are particularly meaningful, our base case is for a soft landing. I think so long as that remains part of the equation, these valuations are actually fairly justifiable, particularly because the rally is being driven by these really profitable companies that are surprising to the upside.
Right, and it was a larger question of, for investors out there, trying to figure out or wrap their minds around whether or not we could continue to see new all-time highs if we did not see the Fed signaling that they were ready to cut here. But for Fed Chair Jay Powell, who's coming out in Portugal yesterday, of all places, won't even say this on our home soil, coming out in Portugal and saying, hey, we need to see more evidence. Is the more evidence just the amount of data, or is it more deterioration?
I think it is a continuation of the trend that's resumed in the second quarter of this year. What we've seen from the inflation data in recent releases suggests that maybe the Q1 sort of hot streak was more of a blip on the radar. So I think what Powell and the rest of the FOMC are really looking for is just this ongoing cool down. But with PCE at 2.6%, when you're looking at that core measure, I think that is a rate of inflation that corporate America is rather comfortable with, and you're seeing that show up in, resilient profit margins and ongoing rolling recoveries in earnings.
Speaking of those rolling recoveries in earnings, though, I am curious the degree to which earnings are going to drive the market heading into the next couple of months here, or is it going to be politics or the Fed? Which of those three do you think defines the next, let's say, 6 months?
Sure. So in the near term, I think with all of the uncertainty that's kind of rearing its ugly head related to the elections, that very well could stoke more volatility. I think as investors continue to play this guessing game of not if, but when the Fed will cut interest rates, that might cause some fluctuations in markets. But at the end of the day, we think that the next big catalyst for equities is going to be the earnings season. And when we pencil in our outlook for the year ahead, it's really that earnings component and not the valuations that's driving our outlook for the S&P 500 to hit more all-time highs over the next 12 months.
With earnings season being the catalyst, what do you think that the theme that prevails this earnings season is?
Look, in Q1, we saw a lot of focus and mentions of things like artificial intelligence. So investors should probably continue to be really focused on not just whether those companies are talking about it and thinking about incorporating it into their business models, but whether they're actually applying it in real time. That adoption will, be a process measured in years, but nonetheless, we do think that it's going to continue to offer tailwinds for the enablers, but also start to cause some beneficiaries in terms of productivity increases or cost efficiencies to emerge across sectors.
Elise, thank you so much. It's always great to have your insights. Really appreciate you coming in studio. Thank you.
Yeah. Elise Hausenbaugh, who is the J.P. Morgan Wealth Management Global Investment Strategist, joining us here in studio. Everyone, let's talk a little bit about Paramount, as we're tracking that this morning, too. Shares of Paramount Global rallying on revived merger talks, according to reports. Production company Skydance has reached a preliminary agreement to buy Shari Redstone's National Amusements, a controlling shareholder of Paramount. Now, if that deal goes through, Skydance would then plan to merge with Paramount Global. Here with some analysis, we've got Geeta Ranganathan, who is the Bloomberg Intelligence Senior Media Analyst. Geeta, just take us into what is finally happening here, it seems like. I mean, it feels like we've been going back and forth on this since the Obama administration. So what exactly does this mean for investors out there, but also perhaps for consumers?
Yeah, thank you so much, Brad. Good morning. You're absolutely right. This has been dragging on for months and months right now, more than 6 months, I would say. And this is basically what we're seeing is a re-engagement with Skydance Media from the Redstone family. Remember, this had been the talks had completely broken down just about 3 weeks ago. We were almost at the finish line. And in the last minute, you had Shari Redstone kind of swooping in and saying no go to a deal which she had principally agreed. So again, there's a lot of uncertainty here. Shari Redstone will call all the shots. But what we are seeing in terms of what this means for investors, again, with Skydance, what we've constantly seen is that they are proposing a deal which basically favors Shari Redstone, who is the controlling shareholder, favors her over everybody else. So it favors her over Class A shareholders as well as Class B shareholders. And that is something that has the potential for attracting a lot of lawsuits. And that is something that has made Shari Redstone extremely wary. And so it looks like this time around, there is much stronger indemnification language in the agreement that should or could potentially protect her from a lot of the upcoming litigation. But again, none of the deal terms really are very clear at this point, other than Skydance offering about $1.75 billion for National Amusements, which is again the parent company of Paramount, and that there is this 45-day kind of go shop period. I think what it means for consumers, again, is just a whole lot of uncertainty. What we've seen Paramount do recently is they've raised the prices on their Paramount Plus streaming service. So again, what we're seeing is, streaming products all across the board, higher prices, not really a good thing for consumers.
Geetha, it's Madison. It's great to speak with you. Thanks for coming on. I'm just interested in your take on the degree of the upside move that we're seeing in the stock off of this news. It's up over 13%, obviously surging overnight and into the pre-market here. What does that tell you about sentiment from these shareholders?
Sure, Maddie. So I think they're, shareholders obviously are just excited that, M&A is back again on the table. I think just over the past few days, we've kind of seen a change, I think, in overall sentiment. There is obviously now this specter of possibly a Trump administration, and that obviously will ease the regulatory climate. And maybe that's part of the thinking for Skydance and Sherry Redstone as well. But the one thing that we have to remember is that the longer and longer this whole process kind of drags out, the less and the less value that the assets will have. And I think Sherry Redstone realizes that. She's been publicly negotiating for 6 months. That's something that's highly unusual in the media landscape, in any M&A deal for that matter. So for her to come that far and then just drop everything again, that was obviously, it created huge overhang on the stock. And I think she's realized that, which is why she's back at the negotiating table.
Wow. Okay. And so now, as we're kind of really trying to wrap our minds around what this means for the larger media landscape. I mean, this was one of the last major deals, it seemed like, was waiting to finally get over the goal line here. I mean, it's not signed, sealed, delivered just yet, but is this the end of the big deal making, or should we expect more?
I think we can expect a lot more. And I only say that because, media is really in a bad place right now, and that's traditional media. So we've seen kind of the linear network business really being in secular decline. We're seeing more and more people leave the traditional pay TV ecosystem as they kind of migrate to streaming. And that's really not good for companies such as Paramount, such as Warner Brothers Discovery, such as NBC, which have huge exposure to the linear TV model. So obviously, again, it's going to depend a little bit, Brad, on the regulatory climate. But I think if it becomes, much more favorable, I think we're going to see a whole slew of deals, which will include a lot of these legacy media players, whether that's, Paramount, Warner Brothers Discovery, maybe Sony, maybe Comcast and NBC. So I think there's a whole lot more to come. Really
great insight. Geetha, thank you so much for taking the time. Geetha Ranganathan, who is the Bloomberg Intelligence Senior Media Analyst. Great to see you this morning.
Thank you.
Certainly. Everyone, we're just getting started here on the Morning Brief. Coming up, shares of Constellation Brands moving higher on the back of its earnings. We have analyst reaction coming up next. And we'll get the latest read on activity in both services and manufacturing sectors, what this means for the markets and the economy more broadly later on in the show. We've got all this and much more. You're watching Morning Brief.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action
With step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market domination. Tune in daily from 3 to 4 p.m. Eastern.
We're taking a look at shares of Constellation Brands this morning. The stock up over 3.25 percentage points after posting better than expected profit for its fiscal first quarter and reiterating guidance for the full year here. For a deep dive into the latest report, we are joined by Filippo Falorni, Citi's U.S. Beverages and Household Products and Personal Care Research Analyst. It's great to speak with you this morning. Thanks for coming on. So I know that you mentioned that the beer scanner data was a little bit of a concern. What do we know now about the degree to which beer impacted Constellation Brands off of this print?
Yeah, absolutely. Good morning, everyone, and thanks for having me. So, look, the quarter was very solid from Constellation Brands. There was some concern because the track channel data, which is tracked by Nielsen and Circana, showed a little bit of a slowdown, particularly into April and May. But the quarter was better than expected. They reported 8% year-over-year sales growth in the beer business, and 6.4% depletions growth, which is a measure of volume. And those were very strong results and better than expectations that were more in the 5.5% range. So again, continue very strong trends for the beer business, driven by the Modelo Especial brand, which was up 11% in the quarter.
Yeah. Also, craft spirits portfolio achieving double-digit growth in dollar sales. They mentioned that kind of outperformed what they were expecting on the higher end of the spirit segment there. What is the trend that you're tracking within that portion of the business?
Yes, Brad. So that part of the business is part of the wine and spirits segment, which overall has been underperforming. And it's mainly driven by the fact that the biggest part of the wine and spirits business, which, by the way, is only 20% of the company sales, is the wine side. So it's the Woodbridge brand. But as you said, the side, which is the premium spirit side of the business, has been doing extremely well, is up double digit. The issue in that part of the segment is that it's small and it doesn't really drive a lot of the segment sales, but they continue to grow well, particularly with the two big brands that they have there, which are High West in whiskey and Mi Campo and Casa Noble in tequila.
I want to talk about some potential catalysts for this stock moving forward, because you say that you are listening in for innovations to come. Just give me some context, because I obviously don't cover this area every single day the way that you do. How much do those innovations drive sales versus just the bread and butter typical bottle of Corona sales?
Yeah, absolutely. That's a very good point. Like, historically, innovation has been driven about 20% of the company's sales growth any given year. Last year, they had a very important innovation with Modelo Oro, which is a low-calorie, low-carb version of Modelo Especial. And that was particularly successful last year into last summer. This summer, the big innovation is going to be Corona Sunbrew, which is a citrus brewed version of Corona, which, it's very drinkable, very summery, and really good timing with the launch ahead of 4th of July and the summer season.
This is going to be, I think, a big summer for consumption, and it's primarily driven by what we're seeing in sport and the Olympics. Does this company have anything to benefit, at least kind of secondary-wise, from what's taking place within this massive 4-year event?
Yeah, absolutely. Look, sporting events tend to be like a driver of social gathering and a driver of occasions for drinking, for their beer business. When you think about their geographic exposure, they're essentially entirely US based. So for them, they wouldn't have direct implication from the events from the Olympics in Paris, but there will be some secondary impact, as you said, from people gathering and watching the Olympics, or more recently, the Copa America, which has been played in the US. And it's an event that tends to drive a lot of attention, particularly among Hispanic consumers. And Constellation tend to skew a little bit more to Hispanic consumer, with 60% of their consumer base being in that part of the population. So to me, you got Copa America, you got the Euro Cup in Europe playing right now, and then you got the Summer Olympics in Paris. All those could drive more social interaction and ultimately more beer drinking occasions.
You know, as I'm looking at the fiscal 2025 guidance assumptions here, one of the major things that we've heard as a theme over the course of this earnings season is about capital expenditures here. And they're looking for that to come in at about $1.4 to $1.5 billion. And that includes some other factors as well. But I bring that up because do you think the next innovation from Constellation Brands comes homegrown, or is it via an acquisition?
Yeah, look, when you think about their cap expanding, is really to expand their Mexican brewing operation. So right now they have 2 facilities in Mexico where they produce all their Corona and Modelo brands, which are one in Obregón and one in Nava. They are opening a 3rd manufacturing facility in Veracruz, which is in the southeast of Mexico, and that should help give the company enough capacity for them to drive further innovation. Again, there's been an area where they've stepped up innovation more recently in recent years. As I mentioned, Modelo Oro last year, Corona Sunbrew this summer. If you go back a couple of years, they launched Corona Premier, which is also another low-calorie, low-carbs innovation. So I would expect their innovation to come more internally, so from their own brands. And from an acquisition standpoint, look, in the past, they've done a few acquisitions in the beer business. The last one was the acquisition of Ballast Point in 2016. They haven't really been successful, so I would think they will probably continue to push forward on innovation on their core Mexican beer portfolio.
Good note there. Filippo, thanks so much for taking the time here this morning. Great to see you. Filippo Falorni, U.S. Beverages and HPC Research Analyst at Citi. Appreciate it. Another ticker we're watching this morning is Eli Lilly. Shares are up right now fractionally after the Food and Drug Administration, the FDA, approved the pharma company's Alzheimer's drug after facing multiple challenges in its path to market. Health reporter Anjali Kemlani has the details. Hey, Anj.
Hey, guys. Yeah, the good news for Lilly, of course, another drug for them that gets the FDA stamp of approval. And this time, the Alzheimer's drug, which has been struggling to get to market. It's been delayed a couple times, but we've also seen that with competitor Leqembi. That's from Biogen and Eisai. And that is what this new drug, Kisunla, is going to be competing against. That is a market that is pretty tough right now. We've seen Leqembi struggle to really gain more prescriptions for that. And what we know is that Eli Lilly is priced a little bit higher, in fact. So that's going to be an interesting market for them. And just to recap what we know about this drug, it helps reduce cognitive decline by about 35% in 18 months. It's a monthly infusion, just like its competitor Leqembi, but that's a twice monthly infusion. So you do have that burden of getting to a clinic for that. It's for the senior population, 60 and older, and does treat mild dementia. So this is another drug that has to be used earlier on in the diagnosis for Alzheimer's. So that's something to keep in mind for who gets access to it. We also know, of course, that there are scans and the like that have been obstacles and hurdles for patients to get on this. But this is good news for the market because obviously more competition out there. Just a quick note to look at those prices, $32,000 a year for the new drug. Meanwhile, Leqembi at $26,500. So a little bit of a discount there for the drug that's been on the market longer. Good news for Lilly on 2 counts. One, it is now in this new space. Alzheimer, we know, of course, is an area that has been begging for some innovation for some time, but also for Lilly, which we know is on a tear because of GLP-1s, and now adding this to the bucket for its revenue.
Anjali, thank you so much for joining us on that. We really appreciate it. A huge, obviously, update for one of the names you're covering all the time. Thanks so much, Anj. We're going to get to the opening bell here on Wall Street happening right now. So let's do a quick check of the markets. You're looking at a mixed picture across the major indices. The S&P just hovering above that flat line. The Nasdaq just hovering below the flat line here. I want to take a quick look at what we're seeing in the Treasury space because we know that yields were falling after the jobs numbers coming in and continuing claims in particular hitting the highest highs since November of 2021. And you're still seeing that downward pressure, particularly in the 10-year yield. yield and also the 30-year. So looking at the longer end of the curve in terms of the pressure on treasuries following this morning's data. But let's get to Yahoo Finance's Jared Blickery for a broader look at what's moving markets. Jared.
Thank you, Maddie. Not surprisingly, markets are a bit quiet now. I'm looking at the Dow behind me. This is over 3 days up about 0.75%. Just want to show you the Nasdaq 100 real quick, passing 20,000, closed above that level yesterday. And finally, the S&P 500. Over these last 3 days, you can see it's been from the lower left to the upper right. And yesterday was the 32nd record close of the year. So really stacking up there. And I want to focus on the sector action today. The number one sector, consumer discretionary. That's XLY. That was up pretty big yesterday as well. That was a leader yesterday. And I've been tracking on this 5-year chart. Well, that's materials right there. I want to pull up XLY. And on this 5-year chart, we can see a lot of these sectors have formed cups, but you'll notice that this high right here is lower than this record high over here. So a little bit of a different pattern, but could be setting up for a longer term breakout. But just looking at the 3-month chart here, you can see finally breaking to the upside. We got a lot of records with respect to some of the mega caps here, but I do want to get to our meme stocks because cost is definitely perking up. If I sort on an equal weight basis, you can see it as our number one stock here, up 33%. And I was looking at the episode of GameStop surging recently. From here, this is cost. So from this low to this high was 200%. GameStop in the same period went from all the way up to 400%. But this, as we know, meme stocks kind of go up in concert. And so is this the next play? Well, at least today it is, guys.
All right, Jared Blickery, thanks so much. Tracking all things around the opening bell. Hey, for anyone wondering who rang the opening bell today, it was the United States Coast Guard at the NYSC. Macy's, who's authoring the fireworks this year in New York, going to be ringing the closing bell over there. All right, everyone, we're also watching airlines this morning. Shares of Southwest, they are on the move fractionally higher right now by about 0.9% after the airline said it's going to implement what they're calling a shareholder rights plan, and this is an effort to fend off activist investor firm Elliott Management. Shareholders will be entitled to purchase one new share for every share they own at a 50% discount, but that's only if Elliott or another investor acquires at least 12.5% of the company. All right, so they're calling it a shareholder rights plan. What you should know this as more colloquially is a poison pill.
Nice, Brad.
Yeah. I mean, that's what it boils down to. They're trying to make sure that they can fend off any major type of activist play that would impact the airline operator, the seats on the board, and especially if Elliott were to assume a certain position, 12.5% in this particular case, of the outstanding shares of the company.
That's exactly right. And it's interesting because, I mean, our Succession fans out there, like myself, are going to be familiar with the hostile takeover, but the poison pill would protect against that. However, obviously, you can tell by the name, not always giving them the best overall outlook, but it does enable the shareholders to potentially get the best deal possible here. I do want to pull out a quote here because we heard Executive Chairman Gary Kelly saying, in light of the potential for Elliott to significantly increase its position in Southwest, the board did determine that adopting the rights plan is prudent to fulfill its fiduciary duties to all shareholders. And the board does continue to believe it has the right strategy, the right team in place. The plan would be triggered if a person or group does acquire a stake of over 12.5% of the firm moving forward. And like you mentioned, Brad, Elliott disclosing roughly $1.9 billion stake back in June in that letter to the board, and said they feel that their suggestions could boost the stock by over 75% over the course of the next year. But the details of those plans, they included them, but obviously Southwest board saying that they've got things under lock and key here. Yeah. All right, well, we are taking a look at major indices here. Flipping over to the green following the opening bell, you can see the S&P and the Nasdaq, though, just above the flat line, as well as the Dow. We're going to take a look at Strategist predictions for the rest of the year. That's right after the break.
Markets hovering just above the flat line after record highs this week. To discuss Strategist's outlook on the rest of the year, Yahoo Finance's very own Miles Udland is here. You've been tracking the Strategist takes pretty much across the board here. Who is...
I'm filling in for Josh Schaefer. Taking his job for the day.
Who has the most resounding perspective right now on what could prevail in the second half?
Well, I think if you look at the lay of the land, it obviously has to be the folks with the 6,000 price target. But the most recent move was from Lori Calvasina and her team over at RBC. In a note yesterday to clients, raising their price target to 5,700 from 5,300. So we're only 200 points away. All these price targets, and of course Julian Emanuel at Evercore with that most bullish outlook. All these price targets, which really came higher in the last couple of weeks, seemed exciting at the time, but now, of course, with the S&P at 55.09 yesterday, 55 and some change this morning, we're basically right back at these levels. And I think Lori's note yesterday captured the sentiment from a lot of folks. You ask who's the most resounding. There's a sense of resignation, and maybe that's too negative, but there's like this. Look, we were bullish. A lot of Wall Street analysts will say, look, we were bullish. We thought stocks would be higher. Then stocks went even higher than that. And so now we sort of have to, accede to the fact that maybe the market is even more enthusiastic than we imagined. And it's, the Wall Street analyst's job is to basically say, is this going to get better or worse? Right now, the agreement is slightly better, but I don't think there are too many folks who are really pounding the table looking for another 15% rally in the next 12 months because it'd be hard to do that after each of the last 3 rolling 12-month periods are, looking at returns roughly in that range.
Yeah, it was interesting in Calvasina's note where just the wording was so interesting to me about we're okay-ish, we're kind of anxious about this bull rally. It was not an excited, rah, we're getting to record highs feeling. I'm curious, what does that tell you about the conviction under this rally and the degree to which maybe the folks whose notes we all soak up every day are maybe thinking, I don't love that this is all driven by one stock?
Well, yeah, one stock, one theme. Yeah. And I think everyone has a similar outlook where earnings this year are going to be up a little bit, not a huge move in earnings in 2024. The consensus view is about 10%, another 10% increase-ish, give or take a couple percentage points in earnings next year. And so I think some of that ambivalence, if we want to call it that, we're basically seeing stocks move higher on expected earnings growth, but it's happening now. So kind of the idea maybe is the best we can do next year is meet that, call it, I think, Lori's looking for 268 in earnings from the S&P in 2025. Consensus is right in that ballpark. So unless you see 15% earnings growth next year, and we know that most of the earnings growth has been from NVIDIA, Meta, Microsoft to an extent are the main drivers there of year-over-year earnings growth. So if we're already seeing that pulled forward into this year, the balance of the S&P is kind of flat. How excited are you going to be on a market that's gone up 30-some-odd% over 18 months, looking for 10% earnings growth next year, and you've kind of realized those gains? Now, it's not exactly the way that markets work, but I think that logic loop is essentially what you're going to be walking clients through as you talk through this process.
I want to get your take on another note from earlier this week. Mike Wilson talking about the risks to inflationary pressures if Trump were to enter office again. Come November, talking about inflation from tariffs and potential immigration policies. This brought me to a question that I came up with during reading your morning brief about whether AI or politics would drive markets more in the second half of the year. Yeah. What's your take on that?
Well, when you asked me, I said politics, but then as we talked through it, I think the answer has to be AI, probably for all the things I just said, right? Like the market's rally this year, if we are to accept it's driven by earnings growth, and almost all the earnings growth is driven by the AI theme, then while it is going to be a more interesting conversation around what would any presidential elect's policies mean for X, right? For tariffs, inflation, I think tax policy. I mean, look at what happened in 2017. I think tax policy is the most important part of this, whether it is a Trump or Biden win in November. But ultimately, if the market has very clearly declared itself, I mean, I kind of started the piece with this, right? The market's declared itself as an AI market. There's really nothing else to talk about when it comes to quote unquote the market, because that is where a bunch of the action is coming from. We look at the index every day. then it follows that it has to be that over the second half of this year. And maybe that gets us all the way back to the ambivalence that a lot of strategists have around the outlook. People do think profit margins are going to be higher. People are fairly constructive on the economic growth path, and GDP, of course, feeds into profits. But these are Wall Street strategists, not necessarily AI evangelists. And it becomes a very precarious position to be in when you're a strategist who thinks the market's going to go higher, but it all kind of depends on what 2027 orders for NVIDIA's next chip are. Like that's the scariest spot to be if you think S&P 6,500, but it just matters what NVIDIA says on its call.
Yeah, really absolutely. True. Miles, thanks for taking some time joining us. Miles of Newsroom fame, Miles Edlund. Appreciate it. Coming up, everyone, a checkup on gas prices, where they're heading this 4th of July weekend, and what it means for your travel plans wherever you're heading. That's next. Auto sales giving big EV energy. Ford is the latest to report its second quarter results, seeing a 1% year-over-year rise in total sales and EV sales jumping 61%. This, of course, follows solid reports from Tesla and GM earlier in the week. Tesla ticking higher today after friend of the show, Wedbush analyst Dan Ives raised his price target on the stock to $300 a share. They're seeing shares of Tesla move higher by about 3.4% here in the early innings of today's activity here. But we should also note that it really comes in a period where there was so much concern coming into these prints that it was almost just this massive weight and perhaps pushing down some expectations, limiting expectations, and companies essentially coming out and saying, no, there's still a fair bit of fodder out there in terms of the consumers that are willing to get into the EV landscape for Tesla's sake. And then for Ford, this is a big deal, especially as they've kind of moderated their own plans within their own EV development, thinking about the Ford Blue business versus the Ford ICE business as well historically.
Yeah, it's interesting, too, given what we've seen from some of the other analysts ahead of the deliveries numbers that we got out of Tesla in particular. This note stood out to me from Citi saying they recommended buying Tesla August 24th, $195 calls ahead of 3 upcoming catalysts. They list, of course, the vehicle deliveries that we just got, quarterly earnings for Tesla expected coming up on July 19th. We've got the upcoming Robo-Taxi Day on August 8th. That's obviously going to be a closely watched event for investors. And then And in general, that could all lead to some catalysts for this stock while we await robo-taxi news from the company. And of course, as we get some more information from them in the upcoming earnings print. But also to your point, Brad, and taking a look here at what we saw, not just from Wedbush, but also from Bank of America, John Murphy saying that deliveries were better than consensus expectations and notably better than investors had expected. So also seeing just some additional positive sentiment over the idea that those deliveries did come in better than expected. Interesting to me, though, given that we still saw those headwinds, particularly coming out of China and the degree to which EV makers on Chinese soil are still having the majority of market share in Beijing, but still that didn't impact that headline number, and I guess that's what the street is focused on.
Yeah, BYD, particularly to put a name on it, they absolutely are continuing to not just take market share, but potentially be a market share leader for an extended period of time too. That's compared to what Tesla and the inroads that they've tried to develop within that region, bringing a gigafactory to that region in Shanghai, and then also ensuring that they could try and put even more of that mass market Model 3 in the region as well. Now, Ford has also been trying to do the same with, of course, making sure that they've got a Lightning that is available essentially internationally and specific models region by region here. It was interesting to see within this filing that the vans actually lead in Q2. However, hybrids grew 56%, EVs were up 61% for Ford.
Absolutely. Well, we're going to continue to talk about cars as drivers are hitting the road this 4th of July weekend, and they might find reason to celebrate at the pump. The national average price of gasoline on July 4th is expected to reach $3.49 a gallon. That is the lowest holiday price since 2021, according to Gas Buddy. For more on prices, we are joined by Patrick DeHaan. He's head of petroleum analysis at Gas Buddy. Thank you so much for being here with us, Patrick. So I'm one of those drivers hitting the road over the next couple of days here. Who do I need to thank for these gas prices? What is driving this news?
A lot of this is simply a normalization of the economy, still post-COVID, Russia's war in Ukraine. But all in all, U.S. oil production remains at record levels, 13.2 million barrels a day. Gasoline demand has been somewhat soft this summer, so you can almost thank consumers for that. As we go into July 4, we're seeing gas prices that are basically on par with what they were last year, at least nationally. But here's the big news. 10 states where you can find average gas prices 25 cents a gallon or more below last year. If you're on the West Coast, you're a big winner. Washington State seeing prices 66 cents lower this July 4 than last year. Oregon, Alaska, Wyoming, all seeing prices about 35 cents lower this July 4 than last year. So some big savings out there with gas prices basically on par with what we saw last July 4.
You know, Patrick, we were just taking a look at WTI and Brent, both of them hovering right now mid-80s, low to mid-80s level. What is your kind of top-end projection for where we could see this move to in the near term?
Well, I think there remains some upward pressure in oil markets. As you mentioned, WTI about $83 a barrel. It seems like we may be bouncing off an upper limit, although we could go a little bit higher. There's certainly been a lot more anxiety in the market here over the last couple of weeks. WTI up about $10 a barrel from where we were in early June. It's hard to pinpoint exactly the sentiment shift here, although I think we're in a little bit more bullish sentiment that could be helped by Middle East violence between Israel and Hezbollah. Obviously, some central banks globally starting to lower interest rates. That could boost demand slightly. Also, we're in the midst of now what's the earliest Category 5 hurricane in the Atlantic that we've ever seen. So it's a stark reminder that as global inventories are starting to decline, we could be on the hook for some additional risk here in the second half of the summer. I think WTI could go a little bit higher here, especially if we do see a major organized storm. I think maybe $90 could be tested briefly before we start to get to those cooler months. I think the coast starts to clear in September and October, and that could usher in a national average that falls below $3 a gallon later this year.
So talk to us about that hurricane season you mentioned. It's obviously top of mind for investors, but oil markets could be moving not just on weather, but also on those geopolitical tensions over the next couple of quarters here. Which do you anticipate being the bigger catalyst for oil?
Well, you know, I think the Middle East is certainly worrisome, especially when you talk about Israel and Hezbollah going at it and how Iran now has a presidential election. There's a lot to watch geopolitically But for now, I think kind of the story is still with U.S. consumer. We saw some really bullish travel numbers, but I think it's important to mention that U.S. gasoline demand is still far below record levels this July 4. Now, the U.S. economy could start to improve, but we're really the trendsetter when it comes to global gasoline consumption. U.S. gasoline demand really struggling this summer to hit 9 million barrels, where prior to COVID, it was routine that we'd see demand well over 9 million barrels and potentially even approaching 10 million barrels. So I think that's part of the conversation here is still a U.S. consumer that may not be hitting the road, but more traveling. You look at TSA passenger screening numbers, they're at record levels, but I think that's still we're in the post-COVID world where consumers may not be road tripping as much this summer, but they may be gravitating towards jumping on a plane. Airlines seeing more capacity and lower airfares than we saw last summer.
I'll be jumping on my bike, Patrick. Appreciate it. Patrick DeHaan, who is the Gas Buddy head of petroleum analysis. Appreciate it.
Thanks for having me.
Thanks. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. Let's get to our vibe check today. New York City's congestion problem is leading to a life of luxury for some people. 6 hotels in the city are providing free helicopter travel from JFK and Newark. The flights are operated under the urban air mobility company Blade, and customers must stay at the hotel for a 2-night minimum here. Now, these are not any cheap hotels on this list, we should note. But of course, this is a premium that perhaps you're willing to pay a little bit for if you just want to make sure that you can get to your suite, kick off your shoes, and, you know, get one of those plush bathrobes. Why not?
Yeah, we've got a breakdown of these prices here on your screen. So definitely not getting that helicopter ride for free at the Ritz-Carlton. The average price for their Liberty suite that you'd have to stay in to get access to this helicopter transportation is hitting around $3,395. For the St. Regis, that's just above $3,000. And at New York's Edition Hotel, that's going to be around $2,500 for the Flatiron Suite. So really getting a deal there at the Edition for only $2,500. I also know that for some of these hotels, there is a catch in terms of the number of nights that you have to stay to have access to this. And we should mention this would be operated by Blade Helicopter. This is an urban air mobility company that did go public a couple of years back, and it's interesting to see that this stock is actually down off of this news, so not seeing some upward movement on the stock off of this potentially because, I mean, it's interesting to figure out the financials behind this. I would be curious to see how much the hotels are paying Blade for this service, and also how the financing works. If I was someone who was already paying for these suites and the cost of the suite didn't go up, I'd be like, well, then what was I paying for in the first place?
Yeah. Well, I mean, for Blade, it's a very expensive business to operate, and a company that originally, I believe, had been trying to, or at least put together a pitch to go public, had some timing, I think about 2018, and then eventually went public via SPAC. And so that's why perhaps you're seeing it kind of sputter, at least in its life as a publicly traded company right now, just above $3 a share. And most of the SPACs, the kind of earmark figure that you see many of them going out the door at is about $10. So at the end of the day here, it's been a tough ride of it, choppy, if you will, or turbulent for Blade. You know, just the air travel puns, they run abound.
No, you're right, Brad. Yeah, they went public in 2019, a little bit of a free money environment, and via a SPAC, which we know led to a wide variety of companies going public that maybe wouldn't have in our current interest rate environment. But nonetheless, you and I can look forward to never having access to this type of hotel room. So
no, we're not saying never. We are speaking these things as though they were.
Anchor of wealth. He's going to be fine. He's got it.
Well, I hope so one day.
All right. Well, coming up, we are going to have breaking data on the services sector right at the top of the 10 a.m. hour. Myself and Bradley are going to dive into those numbers at the top of our show, Catalysts, after the break. 10 a.m. here in New York City. I'm Madison Mills alongside Brad Smith. Thank you for joining me at the top of the hour here,
Pleasure.
Brad. We're going to dive into the catalysts that are moving markets today.
That's right. This holiday shortened week has been packed with data from the labor market to manufacturing and now services PMI crossing. We'll discuss what the latest numbers could mean for the Fed's pathway forward.
That's right. And the latest sales data from Tesla, GM, and Ford showing positive signs for EV demand. We're going to dive into the outlook for the broader industry.
Plus, President Biden blaming jet lag for his disappointing debate performance as Trump comes out on top in fundraising efforts. We'll dive into the next big catalyst for the general election.
That's right, but first we got to break into these June services PMI data that we've got from ISM coming in at 48.8 versus the 52.7 expected. So coming in below expectations here. I just want to run through some of these numbers because we are actually seeing Treasury surging following these ISM services number coming in again lower than anticipated. But running through these numbers, we've got factory orders for April actually revised down to 0.4%. That's according to the Commerce Department. New orders ex transportation falling 0.7% in May after rising 0.5% the prior months. We've also got capital goods, non-defense ex aircraft new orders for May falling 0.6% after rising in April. So seeing several reversals there in terms of numbers coming in. I do want to run through actually some of these ISM services numbers in particular. Business activity falling to 49.6 versus 61.2. New orders also a big drop off there coming in at 47.3 versus 54.1. And then prices paid also falling to 56.3 versus 58.1. So seeing quite a few of these data points here, Bradley, falling off in terms of this broader print that we got from June U.S. ISM services and also May factory goods orders that I was running through there also coming in below expectations.
Yeah, just taking a look at the market reaction. As of right now, we're still to the upside across many of the, in fact, all of the major averages here in the U.S. The Dow holding on to gains by the hair of its chinny chin chin, but just kind of to zero in a little bit more on that June services ISM report that you were running through some of the numbers so well on. Some context here. Economic activity in the services sector contracted in June. This is the second time in the last 3 months it's done that, says the purchasing and supply executives in this latest report on business. And then this to them also indicating sector contraction for the third time in 49 months here. Wow. So that potentially something for people to really kind of take away top line from this report, as we're seeing markets remain pretty steady, holding on to gains as we mentioned here, but this some critical activity in terms of the contraction. And then just lastly here, the business activity index registering 49.6% in June, 11.6 percentage points lower than the 61.2% recorded in May, the first month of contraction since May 2020. So just wanted to highlight that real quick too.
Yeah, this is the lowest ISM services print that we have gotten since that critical time period, really the heart of the COVID-19 pandemic, just a couple of months after it surged here in the U.S. So here to help us with this conversation around the services sector, we've got Paul Grunwald, S&P Global Ratings Chief Global Economist. Paul, thank you for being here.
Good morning.
Good morning. So this services data coming in and mirroring what we saw in a really tough economic moment for this country.
Yeah.
Does that lead us to any type of concern that's similar to that moment?
Well, you know, we've been waiting for some time for the economy to slow down, and the surprises have been on the upside, even on inflation. So now we've got a couple of really soft prints, and the focus is going to be on the language coming out of the Fed. We've got a rate cut coming later this year, but they've been waiting for a series of numbers that show a clear deceleration of the economy. This is part of the story. So one number is not a trend, but if we get a couple of more prints like this, I think the rate cuts are going to come into focus.
And so, we brought up this question earlier. Is it a trend in the quantity of data points that we see, or the quality in perhaps the decline or the contraction that we continue to see?
Yeah, well, they're trying to put it all together, right?
Yeah.
They're really looking at financial conditions, which is confidence, it's lending rates, it's spreads, it's asset prices. So the whole thing together. do they have the right policy settings now to guide the economy to 2% inflation and full employment, or are they going to need easier settings? If we get a couple more prints like this, that's a clear signal that they may start to ease off on rates.
Well, and you said in your own note here that the main risk on your base case scenario would be a drop off in either services spending or in labor demand. At what point, like how many data points would you see that were similar to this that would cause you to say, oh, that's a drop off versus the type of softening that we're looking for?
You're right. We've been in the soft landing camp for a couple of years now, but the fulcrum of that, or the support to that, has been services spending in the labor market. So those are the two things we're watching. If we get a string of prints like this, that could call into question. But you're right, in the recent report for our credit conditions, we did identify that the main economic risk is a crack in this sort of solid labor market services demand we've been seeing. And this is not a great print today. We'll have to see if we get a couple of more like this.
Does this increase the odds of a rate cut coming sooner rather than later?
Yeah, it's one data point, but if we extrapolate from here, I would say yes. We're in the December camp now, but September, December is kind of 50-50. If we get a couple more like this, the Fed could potentially go earlier.
I mean, we basically only have a couple more readings, too, in order to really get a sense of what the Fed may do, even as Fed Chair Jerome Powell, speaking in Portugal, saying that they would need to see more in order to potentially put a cut in play here. In September, it seems like that's the highest probability at this juncture.
Yeah, market was kind of 50-50 last time I looked, but after this morning, I suspect it's drifted a bit. But remember, we've had kind of false starts before, and again, we're going to need some more evidence. Next move for the Fed is down. Question is when it happens.
Yeah, well, and it's interesting too because Chair Powell really did sound like he wanted to cut yesterday, right? He said the word progress at least 5 times from my word count. So
well, we know the global cutting cycle has started, right? We've got the ECB, and we had Bank of Canada, Bank of England's probably next. But the Fed, the U.S. economy has been outperforming. Inflation pressure has been strong. So we need the economy to slow down, but we need it to moderate, not to fall off quickly. So this is.
What do the global elections that we've been tracking thus far, and especially in France, but also you're thinking about where we're seeing some movement as well politically in the UK even, how is that impacting the different rate cutting cycles that we're seeing emerge across the world?
Yeah, well, I guess there's two things that kind of go in opposite directions. One is if you've got populists, they like to spend money, so the fiscal juice is going to be more baked into the forecast, and that would tend to pump up activity and inflation. But on the other hand, there might be a confidence effect, what's going to happen to trade, what's going to happen to industrial policy, what's going to happen that could shape markets, which would go in the other direction. So we'll see how the elections come out, and most importantly, the policy platforms and what they're going to get out of those, right? Are they going to be able to enact some of these things? But, there's a scenario there where things slow down quicker and the rate cutting cycle accelerates as well.
Right, it's this question of politics or policy, which is going to drive
Yeah, and I mean, the geopolitics is up near the top of the list as we showed in our recent report. It's not just traditional macro risks we're looking at.
Right. It's always a new regime. Thank you so much for joining us.
My pleasure,
we really
guys.
do appreciate it. There was some great commentary there from Paul Gruenwald. He is S&P Global Ratings Chief Global Economist. Thanks so much. Well, we just saw a handful of big tech names leading stocks higher in the first half of this year and into market all-time highs at the close on Tuesday. So can we expect the rally to broaden out more from here? Joining me now to discuss, we've got Katie Nixon, Northern Trust's Chief Investment Officer. Katie, thanks so much for being here with us. Look, the big question is, of course, whether or not we can keep relying on a handful of names to drive this market higher and higher. How does the macro environment play into that question? To what extent does the Fed and the macro environment, particularly when we are starting to get in some of this data that's showing softening, weigh on a market that is driven by just a handful of names?
Well, first I will say that, we are also in the soft landing camp, and that's a really important underpinning for our thesis that the market will broaden out as we get further and further into 2024. And if you think about it, it's logical that we've had the leadership that we've had. If you look at last year's earnings, without the Mag 7, earnings would have been deeply negative. They were responsible for more than 100% of the earnings growth. And even that pulled forward into the first quarter, where those stocks were responsible for more than 100% of the earnings growth. But with a soft landing forecast for the economy, we do see a broadening out of fundamental strength beyond those Mag 7 stocks. So it really comes down to the earnings growth converging as we get closer to the fourth quarter, where both the Mag 7 as well as the other 493 are really forecast to be kind of right on top of each other in terms of contribution of earnings to the overall market.
Where is the next sector where that natural broadening out might take place or be evident?
Well, it's pretty broad, actually. What we see in 2024 is 9 of 11 sectors in the market are expected to grow earnings, and 4 or 5 of them are expected to grow double digits. So I think it's a real broadening out, and that's really healthy because we don't want to have the market so dependent on just a small handful of stocks in a very small handful of sectors that tend to be very highly correlated.
I also want to talk about the earnings broadening that you guys are mentioning here, because we are starting to see some signs of coolness. Obviously, this services ISM data coming in at the lowest level since the heart of the pandemic in May of 2020. How does the softening of inflation impact the ability of companies to have pricing power and therefore their earnings? And is that a story that has yet to play out and could be a potential headwind on earnings in the next couple of years even?
Well, you raise a really good point, and I do think pricing power has propelled a lot of revenue growth, certainly for many companies in the S&P 500. And we actually see margins remaining pretty stable at around 12%, even after sort of this pricing power has waned a bit. So margins are expected to be strong. And it's interesting because if you think about the first quarter earnings releases, what we heard from many companies was efficiency, operational efficiency. So we know that companies are being very, very careful about how they spend their money in order to really preserve margins in the absence of that really broad-based pricing power. But I will say, as inflation comes down, that will allow the Fed to start easing policy, and I think that would be a nice tailwind for, again, the other 493 in the S&P 500.
What do you think of the theme of this earnings season might be that prevails?
I think it's going to be operational efficiency. I think companies have been ahead of the curve here in thinking about the contours of the economy. I think companies are seeing gradually a weakening in top line growth, whether it's real or nominal. Consumers are consuming less, and they're not as willing to pay higher prices. So that's really going to pressure top line. So I think the theme is going to be operational efficiency and operational resiliency.
Katie, thank you so much for joining us. We really appreciate it. That was Katie Nixon, Northern Trust's Chief Investment Officer. We're turning now to one of the biggest stories of the week, perhaps the year, the fallout of President Biden's debate performance. The president now blaming jet lag at a donor event last night for that performance. So joining me now to discuss, we've got Yahoo Finance's senior columnist, Rick Newman. Rick, thanks so much for being here. Talk to me about the latest commentary from President Biden on what he is blaming his debate performance on and how that's landing with folks.
So he said this at a private gathering with donors, but I'm sure the Biden campaign meant for it to get out into the news. And he said, well, I took 2 trips around the world right before the debate, and it left me so tired that I almost fell asleep on the debate stage. I guess everybody who's traveled overseas can identify with jet lag. And if you combine that with the arduous schedule of a president and so forth, yes, maybe that contributed to Biden's terrible performance. But on the other hand, Biden returned from his last overseas trip on June 17th, and the debate was on June 27th. So let's see, 12 days to recover from jet lag. Is that really the problem here? I think that a lot of people will remain skeptical. And here's another problem for Biden. 40 million plus people saw his terrible performance on June 27 at the debate during prime time, and nobody saw any televised explanation from Biden about why he did so bad. So what Biden keeps doing is he bombed in front of a major national audience, and he wanted that audience. He asked for that debate to happen early, and he got that. So he bombed there, and then he recovered the next day at a campaign event that almost nobody saw. He was energetic and vigorous at that event, but nobody saw it. Mm-hmm. So the people who say, well, in private he seems alert and so forth. This doesn't really matter anymore how Biden seems in private. It matters how he seems in public, and in public he looks terrible. Now, I'll just add one other thing here. He's going to be making some public appearances in the coming days. He's doing an interview with ABC News on Friday. So the Biden campaign gets the idea that he needs to start showing up in public and proving that he is as capable as he says he is. But that could go south for him, just as the debate did. He could end up bombing in those things too. So important things are going to happen during the next few days.
Well, Rick, another thing that's really important here, of course, is fundraising, because Trump's campaign did outraise Biden's in the second quarter here. What can you tell us about how donors have been responding to the debate performance from Biden and how that could impact his campaign?
Well, Biden did take in a lot of money after the debate. We don't always know in the days after one of these events where there's a lot of fundraising. It's usually what the campaign tells you because they haven't yet filed their official record. So we kind of have to take their word for it. And we don't know exactly where all that money is coming from. A lot of that could be small donors going to the campaign, but the big money that goes to the PACs and the super PACs, there's a fair amount of reporting from among those people that nobody really wants to come out. None of Biden's rich backers want to come right out and say he needs to withdraw, but they clearly they're very concerned behind the scenes. And I think in coming days, we're going to find that there are a lot of uncomfortable discussions happening, perhaps with some of these rich donors telling Biden it is time for him to pass the mantle to somebody else.
Lastly, Rick, I want to talk to you about an Ipsos poll that recently came out with voters asked about hypothetical Democratic candidates. When asked about the potential for Michelle Obama to run against Trump, 50% of voters said they would vote for Michelle Obama. Rick, what does that tell us? Is there any chance of that becoming a reality for those voters?
That question shouldn't even be in the poll because this is an urban myth that Michelle Obama, Barack Obama's wife, would ever want to run for president. This is wishful thinking. She has never run for political office. She has never indicated that she wants to run for political office. And why in the world would she? I mean, look at the great life the Obamas have. They go around, they hang out on Martha's Vineyard with the most fabulous people in the world. They make movies. They're rich as can be. They don't have to worry about anything, and they don't have to answer to anybody. Why would Michelle Obama want to give that all up? She doesn't, and everybody should stop thinking that there's any chance at all that Michelle Obama will ever run for president. She won't.
All right, Rick. Well, you really put the final nail in that coffin for those voters. So thank you so much, as always. So. Thank you for joining us and for the great insights, Rick. Always appreciate speaking with you. Have a great fourth. We're going to have all of your markets action ahead right here on Yahoo Finance. You're looking at broader gains, actually, across the major indices. The S&P up over about 0.1%, and same with the Nasdaq. We're going to keep covering all this and more on Catalysts. We are keeping a close eye on Amazon shares, fairly muted this morning, down about 1% after hitting its highest point ever. The stock closing at $200 on Tuesday's close. This is a good sign for the CEO, he will have been in the job for 3 years as of Friday. Yahoo Finance tech editor Dan Howley is here to weigh in. Dan, thanks so much for being here. Look, obviously it's been a record-breaking year for Amazon, hitting that record-breaking market cap. What could potentially drive this stock to even further highs, and how much more pressure is on the name given this record?
Yeah, Maddie, I think a lot of this has to do with Andy Jassy and his kind of cost controls that he put into place. Obviously, there were a lot of layoffs. Part of the reason why they had that pullback last year was because, and the year before, it was because of the overexpansion that they did during COVID. So they basically figured, look, everybody was inside now because of this pandemic, everyone's going to stay inside forever. It turns out that that is not true. People like going out and shopping and doing other things. And so they needed to pull back. They've since done that. They've also seen more growth in AWS, something that Wall Street was nervous had kind of hit its peak and was now just going to kind of slowly grow over time. But AI has helped to drive new expansion there. And the investments that they're making in AI is helping with that as well. So that's really, I think, where a lot of people are going to be looking for Amazon to kind of drive its next level of growth, that kind of ability for them to tap into their AI capabilities. They do have tough competition. Microsoft obviously is basically, best friends with OpenAI, and Google has its own AI capabilities that it's pushing in their cloud services as well. So, it's not as though this is going to be easy for them. When you think about AI right now, frankly, a lot of it is, Microsoft and Google. Amazon, however, is there, and they are pushing it, and so that's something that could be really their next growth driver. On the storefront, the retail side of things, they're trying to take on Temu, go along with the low cost direct shipping kind of goods that could help them on the retail side of things. And then they have Prime Day coming up. I believe it's on the 16th and 17th. And so that should give an indicator of how much people are actually shopping on the retail side. But really, I think it's all going to be about, as everything in tech is right now, AI.
All right, Dan, thanks so much as always for joining us on All Things Tech and, of course, the AI impact in the room. Appreciate it. Now, coming up, the latest auto sales reports from Tesla and General Motors showing that demand for electric vehicles might be back on the rise. Tesla's deliveries came in better than Wall Street anticipated. General Motors also seeing its EV deliveries increase by 40% compared to a year earlier. So let's discuss it with Stephanie Valdez-Streety. She's the Director of Industry Insights at Cox Automotive. Stephanie, thanks so much for being here. I want to start on Tesla because there's been this question, as you know, for many years about whether or not this is a stock that is going to move off of a story that the CEO tells or the business fundamentals. We're seeing it move off of these fundamentals. Is that indicative of a new era for Tesla?
Yeah, I think Tesla is navigating the waves, right? They're between these growth waves. And I think in terms of for automotive sales, right, they haven't had any new products except for the Cybertruck, which is pretty low volume. And if we're looking at this Q2, as you reported globally, in the US, we're probably anticipating a 15% decline in sales. They're still a dominant player. And as you know, they're really positioning on AI robotics. They're going to have their unveiling of the robotic robotaxi in August. So it'll be interesting to see how Wall Street reacts to that.
And I'm interested, too, in the fact that you even bring up the AI and robotics piece. For a name like Tesla, there have been some folks who've come on our show and said they want Tesla to really just dive deeper into owning that they are a car company, and others saying no, they need to hold on to the AI of it all. Which do you think is a more successful route for the company?
Well, I think right now they need to focus on both, right? Because the AI robotics, there's a lot of challenges with it, whether it's like safety concerns, regulations, and they're still a dominant player in the EV marketplace. They just need to have some more product, right? And they had talked about having an affordable EV rollout, I think next year, but I'm not sure the timeline on that. And that's going to be key for them to keep focusing on their product. But I think they're definitely prioritizing AI and robotics as well.
Yeah, you mentioned some more affordable EVs to come down the road. What do you think that could do for the consumer uptake and adoption of EVs?
Yeah, I think that's huge. We've been doing an EV path to adoption study for many years, and as you can imagine, affordability is always the top barrier. And so I think if you think about more options for consumers, if we can have more affordable EVs, that's going to be a game changer. Right now, the average transaction price for an EV is close to 50,000, 54,000, and so that's still, that price premium over an internal combustion engine. And so I think if we can start to get more of these affordable EVs, that's really going to help. One of the things I wanted to mention for, providing more affordable is used EVs. As we start to see more of those enter the marketplace, I think that's going to give consumers some more options at different price points.
And that brings up the point about competition. I'm curious, in 10 years, do you think that the EV space is going to be crowded to a degree that Tesla just feels like maybe a drop in the bucket compared to sort of the market leader in the space?
Yeah, I think that's the challenge with Tesla, right? They've been the dominant player. They still have the market share, right? Potentially could go below 50% this quarter, but you have all the traditional automakers having a lot of product in the pipeline. And so I think there's a lot of competition, and it's all about what consumers like. They like something new, right? Something new, fun, affordable. And so unless Tesla can start to get more product, they're going to start to have other automakers eat into that market share.
Yeah, and in your notes that you sent over to us that consumer uncertainty about the economy and the election could potentially be a headwind, and I was so fascinated by that. Explain to me how the upcoming election could impact EV sales.
I think one of the things that consumers are thinking about, right now we have the Inflation Reduction Act, right? There's incentives for consumers. There's $7,500. Not all vehicles are eligible, but consumers can get that if they lease a vehicle. So I think there's some uncertainty about, should I buy? What if, there's a, something with the IRA gets eliminated? There's not the incentive anymore. So I think consumers are a little bit kind of like waiting it out to see what I should do depending on the outcome of the election. So I think that's one of it as well.
All right. Well, thank you so much for joining us. We really appreciate it, Stephanie. That was Stephanie Valdez-Streety. She's the Director of Industry Insights at Cox Automotive.
Thanks so much. Have a good day.
You too. Now, coming up, after the Supreme Court overturned the Chevron deference precedent last week, we're going to talk about the implications for the financial world moving forward. That's next here on Catalysts.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Supreme Court overturned a 40-year-old precedent known as the Chevron deference, which ruled the courts should defer to a government agency's reading of any ambiguous laws or statutes rather than interpreting it for themselves. So here to explain the potential ramifications of this ruling, particularly on the financial world, we're going to welcome in Leah Dempsey. She's Brownstein's shareholder and co-chair of Financial Services Practices Group. Thank you so much for being here with us, Leah. I want to start just on the kind of interpretation of this news. So as a reminder to folks, this is the idea that, there were limitations within the degree to which lawmakers and political appointees could interpret certain laws. They would defer to experts on each individual type of doctrine and decision. This used to be a bipartisan issue. What changed, Leah?
Yes, well, so interestingly, this came out under Justice Scalia during the Reagan administration in the 80s. It was an interpretation of the Clean Air Act. But over time, I think the conservative wing of the court thought that it became a separation of powers issue where, Congress wasn't necessarily delegating certain authorities to the agencies, but the agencies were seeing a silent or ambiguous statute as the opportunity to promulgate rules that may align with a certain political party. And has been a lot of litigation on this issue. I think over 18,000 cases have cited the Chevron deference. And over time, different courts have looked at this differently. Really, the Supreme Court in recent years has not necessarily relied on Chevron as much. They've relied on a new case, the West Virginia versus EPA, which introduces a whole nother issue called the major questions doctrine. But this ruling is significant and will have a number of ramifications for the financial services industry.
Okay, so talk to me about those ramifications, Leah, and thank you so much for that great explanation there, just giving us the context on how this has really changed politically over time. But what is the most important thing that investors need to know about how this could impact financial regulations moving forward?
Yes, well, and so especially in the last year or two, there have been an onslaught of both financial services and housing regulations. Dozens and dozens of new regulations have been coming out of the Biden administration. Many have already been challenged in court and are in the process of litigation. But this certainly will give ammo to others that are looking to challenge new regulations, particularly in an area where an agency may have gone beyond its statutory authority. So I think, that's one area to look at, an increase in litigation, which will probably elongate the rulemaking process and create a bit of uncertainty in terms of whether rules are going to go into effect or not. There's also the process of seeking clarity through regulators, which will change, for instance, something like AI. There is not a law on the federal books that tells people exactly how to operate in that area yet. And the agencies, in many instances, have stepped in. Here now, it's now questionable how far the agencies may be able to go if Congress doesn't first tell them what to do on those issues.
You bring up a great point, though, in terms of AI, which we constantly talk about as the main driver of this market rally. Given the impact of Supreme Court overturning Chevron here, does that mean that government officials are going to be able to decide what AI regulation looks like moving forward without needing to consult with AI experts themselves?
Well, Congress has a number of pieces of legislation that they're considering in this area. The regulators have also put out several pieces of guidance. The CFPB, HUD, others have put out guidance on this issue. But going forward, depending on what that guidance says from agencies, it could be subject to a challenge now that Chevron is struck down.
I want to zoom a decade ahead with you, Leah, if we can kind of read the tea leaves here, because I remember in high school, like the key sticking point in my U.S. history class and economics classes were we talked constantly about Citizens United and the impact that was going to have on our country moving forward. This feels like the case that the next generation of history students are going to have that exact same commentary on. If you were teaching that history class, what would you tell those students about how this would impact them just in terms of their daily lives and what this country would look like for them?
Well, I certainly think it's going to change the way Congress has been operating over the past few decades. In recent years, they've been leaving a lot of the details to the agencies in many instances, doing that on purpose because they don't want to take a tough vote or get involved in an issue that may not look great in their next election. Now they're going to have to step in and fill in with those details. So the way that Congress operates and hopefully comes together in a more bipartisan fashion will hopefully change going forward, because if things continue as they have this Congress, I believe it's one of the lowest number of pieces of legislation ever passed in history because of the divide, because of the fact that the Speaker of the House was asked to step down at one point. If things continue that way and Congress doesn't legislate on these issues and agencies have a more limited authority to step in, things will get complicated. So I think there's going to have to be a shift in how things are done going forward. And agencies as well are going to have a mentality shift in the way that they promulgate rules.
Yeah, and you make the point as well in your notes over to us that typically Congress would try and push through some legislation heading into an election cycle. So this could complicate that moving forward here as well. Leah, thank you so much for joining us. We appreciate it. That was Leah Dempsey. She's Brownstein shareholder and co-chair of Financial Services Practices Group.
Thanks so much for having me.
We are going to have all of your markets action ahead right here on Catalyst. You're looking at a mixed board here, seeing some pressure on the Dow, the S&P, and the Nasdaq, holding on to gains, but pairing the upside movement that we saw a little bit earlier in the session. Stay tuned for more. You're watching Catalysts.
Marina traffic, experimental 542, Bravo Juliet.
So we're at the downtown Manhattan heliport, and what we're going to do is we're going to take off.
Yeah.
All I want you to do is pull back with your right hand. That will make you go up. Just pull back hard. Yep, and there you go. Now you're flying.
I'm flying.
We're not actually flying above the Statue of Liberty. That's a simulator from Joby Aviation, which is used to train traditional pilots on how to fly this battery-powered aircraft. With the backing of Toyota and Delta, it's one of the largest companies looking to bring battery-powered air taxis to market. These aircraft are called eVTOLs, which stands for Electric Vertical Takeoff and Landing. At first glance, it may look like a helicopter with extra propellers on top, but unlike choppers, eVTOLs run off electricity rather than fuel.
This is for charging. It took us about 6 minutes to get from JFK to downtown Manhattan.
Over $22 billion in investments over the last 20 years from names like Uber, Stellantis, and Honeywell have now made this kind of a commute closer than ever, thanks to advancements in eVTOL technology.
High-performance propeller blades that are very light.
In addition to Delta, major aerospace names like United and Boeing see the potential and have invested with the hopes of one day adding eVTOL rides to their list of offerings. Getting in now makes sense. One research firm estimates the air taxi market could be worth more than $65 billion by 2028. While the tech has proven to work, and it could be even closer to commercial launch in Europe, here in the US, regulation, lack of infrastructure, and customer affordability could be what keeps these companies from taking off. Yahoo Finance went inside Joby's 130,000 square foot assembly facility to learn more about how the company hopes their aircraft and their business strategy will win the air taxi race. This is what's next in the business of electric air taxis. Flying above traffic in a congested city sounds like fiction from the Jetsons. But air taxi companies believe they can make this a reality as soon as 2025.
This is as close as we've seen, I think, in terms of the technology coming together to make something that you could use on a daily basis to go where you want to go and do the things that you want to do, which is kind of what a car is all about, I think. That is something that's going to be practical and available to people in the pretty near term.
The Joby aircraft has completed more than 1,000 test flights. The aircraft can fly 5 people, including the pilot, up to 150 miles.
What can you do with the way you design and build an aircraft if you have a world-class electric propulsion system available, which no other aircraft have really been designed around in some ways?
The 6 motors on the aircraft are powered by 4 batteries, which were developed by a team of ex-Tesla employees.
What that lets you do is fly very, very efficiently, which makes all electric work.
And makes all electric safer, too. Redundancy was built into the aircraft. Everything has backups in place.
So this is a battery, this is a battery. Does that exist on the other side, too?
Correct. So the aircraft has got 4 batteries. You've got that redundancy. You can afford to, we can lose a battery and we still fly perfectly fine.
Electric aircraft face similar challenges to electric vehicles, which don't have the added hurdle of launching into the sky. Among those challenges, battery charging times. Joby can go up to 100 miles on a single charge, meaning it could do 2 trips back and forth to JFK from NYC's downtown heliport before needing a recharge. Joby says almost all of their trips in target markets would allow for recharging that takes about as long as deboarding and boarding passengers. According to one report, eVTOL batteries would ideally charge in under 10 minutes, about as fast as Tesla's latest superchargers. eVTOL companies hope safety measures will give them a leg up as they try and bite into the 10,000 traditional rotorcraft trips per day happening in the US. But first up, getting cleared to fly. A representative from the Federal Aviation Administration told Yahoo Finance that while eVTOLs could launch commercially as early as 2025, 2028 could be more realistic, at least for a scaled and competitive market. The FAA's Innovate 28 initiative outlines requirements for launch. That includes hitting certain safety criteria and flying under a variety of conditions. It's the same approach applied to traditional aviation. Still, certification is not guaranteed.
We don't know when certification for FAA will happen for any aircraft. The FAA changed them to special condition aircraft, essentially, putting more rigorous certification processes on top of that. So I can't imagine that we're going to see an eVTOL in the air certified flying around folks in 12 months' time.
Does pre-2030 seem realistic?
I do think late in this decade we'll have that.
Until then, eVTOLs are focusing on countries with looser regulations. Joby plans to launch flights in Dubai by 2025 through a deal that was supposed to be exclusive, though Archer, Joby's main competitor, later announced their own plans in the region. Back in the States, Joby's on track to hit the FAA's proposed timeline for approval. They've just completed stage 3 of a 5-stage trial. But with testing comes setbacks. The U.S. National Transportation Safety Board released a report on a Joby crash from February of 2022.
I know that there was a test flight that did end in a totaled Joby aircraft. Can you talk to me a little bit about what happened there and how you as a leader kind of transitioned the tech moving past that?
We were flying pretty high and really fast, right at the edge. We were doing it remotely though, so that's actually one of the really interesting early use cases of autonomy that I think is a little underappreciated. We've taken care of it in all of the future designs, but we found it earlier because of the use of that remote piloting and autonomy in a way that I think ultimately is pretty beneficial.
I think autonomous has its own issues, right? The fact that people will feel comfortable not only getting in an aircraft that they've never been on before and having it have no pilot seems like the riskiest proposition.
Still, autonomous flight could boost profits. Pilot salaries aren't public, but the average annual wage for commercial pilots in 2022 was a little over $100,000. That's according to the Bureau of Labor Statistics.
We think that's definitely going to come. We just don't think it's the right way to go to market to start with.
Sure.
Because this gets us to market as fast as possible. And then that's something that will make it even better down the road.
For now, Joby is partnering with companies like Toyota and even Uber, which sold off their own air taxi unit to Joby back in 2019.
I led the Uber Elevate team, which was Uber's effort to build a flying car, in some sense, ecosystem of different companies. We actually demoed this with helicopters in New York City in 2019 when we launched, maybe you remember there was something called Uber Copter. You'll be able to in our app or in the Uber app, essentially choose Joby, a Joby flight, as one of the types of products. But it won't just be a flight alone, it's actually a multimodal integration.
That integration will be needed since Joby won't have many locations available for flights at the start. Here's how it would work in one of their first target markets, New York City. Users would open the Uber app and select the air taxi option. Then a car would come to the customer's door, drive them to the nearest vertiport, which is a converted heliport that can handle the charging and storing of eVTOLs. From there, users would hop in the eVTOL and land at a nearby airport. Joby says in New York City, the flight would take about 7 minutes. Uber isn't the only major company getting in on the action. Toyota invested nearly $400 million into Joby, and Delta invested $60 million. Archer, Joby's biggest competitor, has a $1 billion conditional order from United Airlines and raked in $150 million from Stellantis, as well as some well-known investors, including Cathie Wood via her ARK Innovation ETF and serial entrepreneur Mark Lorry. Major air taxi firms Joby, Archer, and Lilium have all had gains on the S&P 500 this year. To see this investment put to work, Yahoo Finance went inside Joby's assembly facility, which, following the Toyota investment, now runs a lot like a car assembly line.
So this overall is our final assembly facility. So we are bringing in all sorts of parts, all of the many different parts that go into the aircraft. Many of them get built here, and then we have a process where we put them sequentially in the right order, in some sense, onto the aircraft to build out that full aircraft. We are vertically integrated. We build the parts, and then we assemble the parts together into structures. And so what we have behind us is one of our structural assemblies for a fuselage, which is the body, the main body of the aircraft.
That vertical integration is part of what attracted Delta to Joby.
We spent at least 18 months looking at over 20 different eVTOL startups, really looking at what each one had to offer. Because of the technological strength that Joby had, the financial strength that they had as a startup, we felt that that made a great match for us to be able to collaborate.
Let's take a look at how the markets are doing about 90 minutes into your trading day here. I want to take a look at the broader and major indices. Looking at the Nasdaq there, it is up about 0.3%. Let's see if I can get the other markets to pop up here, because what's interesting to me is that we are seeing the Nasdaq Composite up higher than the S&P 500, though this is the highest that I've seen these indices be on the day here. Interesting in comparison to what we were seeing in the Treasury space, seeing Treasuries falling off a bit following that ISM data coming in at the softest levels in the past 4 years. That's also why you're seeing a little bit of weakness in the dollar as the market starts to price in a higher chance of the Fed cooling off interest rates earlier than anticipated, likely seeing an uptick in the rate cutting belief for September there as well. I also want to quickly take a look at oil, because we know that oil moving after EIA did announce a drop in inventories. You can see that impacting the futures here for crude and Brent and WTI rather as well. So taking a look at your broader market, though, still seeing some gains in the major indices. We'll see how that shakes up for the rest of your shortened holiday trading day. Coming up here, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, new data shows some weakening in the labor market. We'll help you understand what it means for the economy and how it'll affect your job prospects, and how to save money this summer. We dig into the tips and tricks that you need to save a little cash in the summertime when the weather is right. Plus, getting around without connectivity. Our tech reporter is going to give you the skinny on how to manage your life should you be without technology. All that and much more during today's show. But let's get back to the economic data this morning. Private employers in the U.S. added fewer jobs than expected in June, 150,000 according to ADP. That is the third straight month of slowing job creation. Joining me now to break down the data, we've got Naila Richardson, who is the ADP chief economist. Great to see you. And as always, thanks so much for taking some of your time after this fresh data drops. Want to get your read in on exactly what we're seeing in some of the moderation in key sectors. I remember looking through this report earlier this morning, and you essentially said in a nutshell, had it not been for leisure and hospitality, we might have seen a much different report.
That's correct, Brad. And it's great to be with you. This is the third straight month of job declines. Declines in job gains, I should say. So we've seen this gradual cool down all year, but particularly over the last 3 months. 150,000 jobs is solid, but it's not broad-based. It's really coming from a couple of sectors on the services side. And leisure and hospitality, as we noted in the press release, is responsible for the bulk of the gains. It was 42% of the hiring this month. So the question before us is, can the labor market continue with this gradual cool down when there's just one or two sectors really driving the gains every month?
What does that signal to you about wages right now?
Well, we don't need the signal. We actually have the paychecks. So at ADP, track over 10 million workers every month for this report, anonymized, but individual to individual matches. And this is the first time since August of 2021 where job gains for job stayers have broke below 5%. That is significant. Yes, it's a significant milestone in our trajectory back to a wage growth that is consistent with 2% inflation, but it's still elevated from pre-pandemic levels, and the declines in job growth are slowing. So we're not seeing big jumps downward. We're seeing an edging down in a very slow and gradual way with these annual job gains.
What about for job hoppers on the other side? Those who are looking across some of these listings online and saying, you know what, I think I fit the bill, I fit the prerequisites to be able to throw my hat in the ring, and I'm looking for a little bit of a pay bump too.
And they'll get it. In this market, we're still seeing a pretty elevated pace of pay bumps for people who changed jobs within the last year, about 77.7% annual growth for job changers. But there has been some shifts, notably in that very leisure and hospitality sector that's driving a lot of the gains this month. We're seeing that you don't get the same pay bump that you did a couple years ago. In fact, leisure and hospitality is the one sector when we look at job switchers where you actually lose money from changing jobs. So that is a key difference in terms of how the sectors stack up in the month of June.
Additionally, we got to give people some actionable tips here. Say that they are looking for a job right now and trying to make sure that in whatever capacity that they're seeing hiring or even some pullback in the number of jobs that are open here, where can they make sure that they are kind of deploying their best efforts? Where are some of the hot sectors?
This is not a hot sector market. It's a cooling market. So the first thing to note is that it may take a little longer to find that next job than it would have taken a year ago. People are staying in their jobs longer. We saw that in the JOLTS data, the job openings, hiring, and quits data that came out from the BLS earlier this week. quits rates are about the same pace they were before the pandemic. So this is not a place where people are leaving jobs and there's a lot of job openings that come to fruition. It also means that there are some segments of the economy that are slower than others. So if you look at the good sector, manufacturing, construction, natural resources, it's slower than services. So if you want a quick job, I would head to customer-facing jobs in healthcare and leisure hospitality. But if you want a high-paying job, you might have to wait a little longer for that manufacturing job or that construction job, perhaps in professional business services. So patience is the key for the Fed, and now patience is the key for people who are looking for a new job.
All right, patience in the job search type summer. Naylor Richardson, thanks so much for taking some time here with us today. A lot to really wrap our minds around over the course of this week with some of the employment data, readings such as that from ADP. ADP Chief Economist Naylor Richardson, great to see you.
Thank you. Good to be here.
Certainly. Turning now to three stories impacting consumers. First up, insight into workers' pay. A big takeaway from the ADP print this morning, pay increases for American workers. They've continued to decelerate here. The annual wage increases for workers who stayed in their same job, that increased at the slowest rate in nearly 3 years in June here. Now, for job changers, annual wage increases slid for a third straight month. And as we talk about how much people are making, we can also see that they're spending more of their wages on housing here. Housing affordability remains a big pressure point for Americans. According to Adam, a real estate data firm, major expenses on median-priced homes now consume 35% of the average national wage in the second quarter. This is the highest level since 2007. And with housing eating into more of your budget, you may not be thrilled to learn that inflation is hitting your 4th of July barbecue as well. According to the American Farm Bureau Federation, the average cost for a 10-person cookout is $71.22. That's up 5% from last year and up a whopping 30% from 5 years ago. Meat prices will greatly affect that budget. 2 pounds of ground beef costing an average of $12.77. That's up 11% from last year. Altogether here, the consumer has been resilient, even if increasingly showing normalization in certain areas. But there are signs of weakening in the labor market, high mortgage rates remaining burdensome, and inflation still hitting Americans' wallets as of right now. We've got much more coming up on wealth after this short break. One popular measure of volatility for investors has been relatively subdued over the past few months. The CBOE Volatility Index, known as the VIX, is off more than 3% so far this year, indicating expectations for volatility in the S&P 500 have been somewhat muted this year. Some on Wall Street believe that that's about to change, though, as uncertainty around the Fed's potential rate cuts, plus a presidential and general election, could see market volatility spike. For more, I'm joined by Anthony Sicaro, who is the Providence Financial and Insurance Services President. Anthony, great to see you and great to have you back on the program. What are the best ways to protect oneself against a potential market downturn?
Yeah, I think what you really want to do is you really want to focus on the phase of life that you're in and the strategies that you're using for that phase of life. The fact is that if you're heading towards retirement and you have more than 10 years away to retire, you should continue doing what you're doing. Dollar cost averaging, have money come out of your paycheck every year, every paycheck, continue driving that average price down. That's what dollar cost averaging does. I wouldn't change anything there. But if you're a little bit older, if you're maybe a decade or so, especially if you're 5 or 10 years or less away from retirement, you probably want to start shifting from the more aggressive investments which have served you well over the last 10 or 12 years into more conservative income-based investments. And if you're retired, same thing. It starts shifting from a growth-first, income-second mentality to an income-first, growth second mentality the closer you get to retirement. I think that's the number one thing you need to do. And with the market at record highs, it's not a bad time to start making that shift.
So what are the 3 risks in the back half of 2024 that investors should be paying closest attention to that could insert more volatility into the equation?
Yeah, well, certainly inflation is one of those risks. It has softened. It has started to come down a little bit. It stalled in the first quarter, came down a little bit, right? The PCE and CPI numbers were favorable, not by a lot, but we'll take it. And that's certainly one risk, that the price of things stays high. That makes it more expensive to live, makes it more expensive for credit, makes housing costs more expensive. So that's one risk for sure. A second risk is that we have a recession. We're not out of the woods yet. The labor market is softening. It's not soft enough. The inflation, as we talked about, is softening, still not soft enough. We still have an inverted yield curve. An inverted yield curve indicates and has indicated historically that we have a recession coming. Our yield curve now has been inverted for more than 2 years. That's not uncommon for an inverted yield curve to be that inverted that long before a recession happens. Additionally, the expectations index is under 80. Generally, under 80 has been a good predictor of recession. So we're not out of the woods. A recession is potentially a risk as well, too. And I think geopolitical risks are there as well. The trade tensions with China, the tariffs, the presidential election is going to come into that. And we can't underestimate still the fact that there could be a terrorist event. We've had it happen before. Our government's done a great job of protecting us, but we've got some wars going on. And if we had another terrorist event in this country, that could be a risk as well, too. So I think those 3 are the 3 to really focus on and to do what you can to mitigate at this point.
Wow. Yeah, that last one wasn't on my bingo card, and I'm hoping it doesn't come true. But, of course, exogenous threat that and many investors always have to think about here. As we're thinking about, though, the sectors that investors should consider in Q3, which are those that you're leaning into right now?
Yeah, Brad, the reality is if we are thinking that there could be a recession, and I don't know if it's Q3 or beyond, I don't think Q3, but going forward, you want to prepare for that before the recession comes. And so Q3 would probably be a time to start. Consumer staples is a sector that I think makes sense. It hasn't done well. It hasn't done well recently. This year to date, it's up, I think, 7.5%. 2023 was not good. But it's a defensive sector. They can pass on the cost of inflation to the consumer. And no matter what, you're still going to buy toothpaste. So, the consumer staples, I think, is a good sector to focus on if you think that the recession narrative has potential to play out. Same is true with utilities for a lot of the same reasons. You're going to continue paying your gas bill. You're going to continue paying your electric bill. So I think that's they can pass the inflation on to consumers as well, too. I think that's another sector to focus on. And then finally, real estate investment trust. This sector has not been good for a couple of years because of high interest rates, because of the high prices in real estate. But if interest rates come down, a lot of experts think that real estate is going to pick up again, going to become more active. Rents pass their inflation on to the lessees, the tenants. So the reality is, I think that's got potential to pop, and you're going to get high dividends, not only from the REITs, but from the utilities and from the consumer staples as well. So I think these are three sectors that if you're going to buy into the recession narrative, and I think is inevitable at some point, these are three sectors I think that are probably good to focus on.
Anthony Scaro, Providence Financial and Insurance Services President. Anthony, great to see you. Thanks so much for taking the time.
Thank you, Brad. Thanks for having me.
Certainly. Well, we've all seen the headlines. Tech is driving the markets higher this year. The tech sector is up around 20% year to date. Compare that to small caps, which are up less than 1%. Despite the trend, our next guest thinks now might be the time to get into small caps. To discuss, let's bring in Matt Kaufman, Calamos head of ETFs, here as part of the ETF report brought to you by Invesco QQQ. Great to see you. Okay, so walk us into the thesis here, Matt, for why we could see perhaps a trend in a new direction.
Yeah, good to see you again. This year to date, small cap stocks, they're trailing large cap stocks, as that chart showed, by the largest amount that we've seen on record since 1998. It's about a 14% dislocation relative to the S&P 500. So, as you've said, we've seen large caps really enjoying a nice run since the down market of 2022, and small caps really didn't participate in that run. We're seeing the Russell 2000, a broad measure of small cap stocks, still about 17% off its record high from 2021. And so a lot of this underperformance is really interest rate driven because small caps rely much more heavily on external financing than their larger companies. So, over the past couple of years in that small cap space, we've seen lower earnings, lower margins, the cost of capital has gone up along with interest rates. Today, we think this is largely priced in. And so if interest rates do begin to fall again, we may see, one cut or so this year. We could see a surge in small cap prices as a result. So as those falling borrowing costs occur, that really can become a tailwind for small cap stocks.
How detrimental is the timing if we don't see a cut until December versus what's being projected right now, or has the leading probability for that first cut of September? What is the kind of net delta, if you will, for performance of small caps over the course of this year if we did see it delayed?
Yeah, we think a lot of that underperformance, again, is priced in, and we're already seeing some of that outperformance occurring. We have a Timpani mutual fund, small cap mutual fund, that's starting to outperform its competitors and perform well in that small cap space. But you're right, we do see volatility in that small cap space. And so we're encouraging people to look at the small cap area, but enter it with a measure of risk management.
Okay, so what are some of the top ETFs that you're seeing investors flow into right now with this strategy in mind?
Yeah, there's a couple of products that we're seeing people, be able to poise for that rally in small caps. On Monday, we launched CPRJ, which is a 100% downside protected ETF that gives you exposure to the Russell 2000. And so we launched that on Monday. The cap rate on that product is 11.2%, which is the highest cap rate of any capital protected one-year product in the market today. So it allows you to participate in potential growth in small caps, but in a way where you don't participate in those downside moves over the next year. So for folks with, a one-year time horizon or greater, moving into a capital protected Russell 2000 product like CPRJ, I think makes a lot of sense for folks. And then the second product we're seeing, just to do next 10 seconds here, is CVRT. It's a convertible product, which is owns convertible bonds largely issued by small mid-cap stocks. And so those are high equity sensitive convertibles. We see a run-up potential in that as well.
Matt, great to catch up with you. Matt Kaufman, who is the Calamos head of ETFs. Appreciate it.
Right.
Certainly. Coming up, what do you do if you lose internet on your phone for hours or even days at a time? We've got some tips when we return. Tech support's coming up. Whether you're stranded in the Amazon rainforest with 0 bars and a dream, or you're simply out on the town with a phone you forgot to charge, like me, not having access to all of your tech can be incredibly stressful. But have no fear, because our own Dan Halley is here with some important tips for you on this week's edition of Tech Support. Dan, you were on vacation last week. I hope you had a great time, but you actually had some tech issues yourself. What happened?
Yeah, I was away in Ireland and Scotland, as you can see from this incredible tan that I have right now. And there was a third-party outage with a provider that actually provides roaming services for Verizon, AT&T, and T-Mobile users outside of the U.S. And so while I was traveling, internet just went down for us entirely. We couldn't connect to anything when we were out and about in cities that we really don't know.
And so what are some of the tips that you have for people who may not have full internet access, whether for traveling or even if you're dealing with an outage as you did?
Yeah, I mean, there's a few things. I think the main is to find Wi-Fi wherever you can. Before we would go out, we would use Wi-Fi to look up where we were going, to make reservations, to order a cab. When we were out, we would stop at cafes or restaurants, sneak into a bar, and then try to grab the Wi-Fi there and use it to continue on our journey wherever we had to go, look up what we needed to, check our Airbnb status, things along those lines. It was, a little harrowing at times trying to figure things out. It also was an excuse for me to put my phone down, which I did not do. But my best friend and my wife managed to do that while we were traveling. But there's a few other things you can do as well. You can download Google Maps for offline use if you're in a city you don't know. That was really helpful. You can also do things like use Apple's satellite messages or messages over satellite. That's going to be coming in the fall. Right now, they have emergency SOS. So if you are truly stranded somewhere and you have no network connectivity, that's something that you would probably use. It connects you to emergency services. It's not something to be like, oh no, I can't find where the restaurant is that I'm looking for. That could be something that you would use Apple's upcoming messages over satellite service would be used for.
And we only got about 30 seconds left. What about connectivity issues, whether that's a problem with the network, your phone, or your account?
Yeah, I spent probably 2 hours resetting my phone over and over and over again. That's usually the first thing to do, start and restart your phone. Then if you have other connectivity issues, you can actually reset your network settings entirely in your phone. That's something that's pretty easy to do. Unfortunately, that didn't work for us because of this larger outage. The last thing that you can do is when you do have Wi-Fi, look up to see if there's any widespread outages for your carrier or a carrier service. And that's what ended up happening for us. The key thing, just find that free Wi-Fi wherever you can.
There you go. Dan Halley, thank you so much. Appreciate those tips. Actionable for anybody out there that is perhaps low on tech resources. Appreciate it, Dan. All right, that's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. Stay tuned. Market Domination, Josh Lipton, Shauna Smith. That's coming up next.
Hello and welcome to Market Domination. I'm Josh Lipton alongside Shauna Smith, live from our NYC headquarters.
We are giving you the ultimate investing playbook to help you tune out the noise and make the right moves for your money. Just about 90 minutes to go until the market close. Let's get you up to speed on what we're seeing play out in today's market action. We are looking at the Dow under a bit of pressure, off just about 0.2%. But let's turn our attention to what we are seeing in terms of those record-setting highs. The S&P on track for another record close if these gains hold for the next 90 minutes. You're looking at the S&P pushing further above the 5,500 level. And then when you take a look at the Nasdaq Composite, closed above 18,000 for the first time yesterday. We're now looking at another gain of nearly 0.5% there. Flipping it over to the bond market here, a bit of a different story really than what we've seen play out over the last couple of trading days. You're looking at the 10-year yield dropping by about 9 basis points, pulling further back from that 4.5 level that it had been pushing up against not too long ago. Now, the reason behind why we are seeing these moves play out in the markets today is on the heels of some of that econ data that we've gotten out over the last couple of hours of reading on ADP print, and also when it comes to jobless claims, both pointing to a labor market that is slowing down just a bit. And then we also got the services PMI also showing some weakness there. So that's adding, or really, I guess, giving the market some confidence that maybe the next move is going to be or will be a cut, but maybe that cut is going to come sooner rather than later. When you take a look at the sector action here today, you've got technology, utilities, materials there among the outperformers. On the flip side, you've got consumer staples and tech and healthcare there under a bit of pressure. But again, a bit of a mixed picture when you take a look at the sector action, but the XLK leading the way today, and you can see that reflected in the outperformance of the Nasdaq there, Josh.
Shauna, thank you. The S&P 500 and Nasdaq aiming for another record close as investors are digesting a fresh batch of economic data, plus comments from Fed Chair Jerome Powell, and await, of course, the latest Federal Reserve minutes. Joining us now is Zach Hill, Horizon Investments Head of Portfolio Strategy. Zach, it is good to see you. So, Shauna, as Shauna was hinting there, we saw some weaker than expected economic activity and data, Zach, this morning, labor market, U.S. services activity. What did you make of that data, Zach? What do you think Jay Powell makes of it?
Yeah, well, Josh, thanks for having me, and happy early 4th of July. So we definitely got a little bit of a weak data print today, especially that ISM services number came in fairly light, although, just looking at the last few releases of that number, they have been quite volatile. It surprised to the upside really considerably last month. And so, this downside surprise, I think we need to take in a broader context there. Really for us, I think we're looking to Friday's jobs report. Continued strength in the labor market is really key to our view that, the consumer is in better shape than a lot of people think. And we think that's good for risk appetite, especially when, as we heard from Chair Powell yesterday, he wants to cut rates, and he's just waiting for the right data to do so. And so he nodded to progress on the inflation front. And so if we continue to see that, throughout the summer, we do expect to see the Fed, lowering rates marginally sometime in the back half of the year.
Zach, do you expect the disinflation trend to stay intact?
I think we're going to be bumpy. I think it's just. We don't understand as much about inflation as I think we thought we did in the 2010s period. But broadly speaking, if I look at the bigger trend, we're not going to go back to what we saw in 2022 or early 2023. Whether we settle out at 2.0 or 2.3 or 2.4, that's in our view, really rounding errors in the bigger, broader picture. We do think that inflation is largely under control, and at the same time, the economy is showing that it's more resilient to higher interest rates. And so, while the Fed is going to cut, and the Fed's going to cut at some point soon, in the grand scheme of things, it's not really as big of a deal as we would have thought in this last cycle, just because the economy is just running hotter than it has really since the global financial crisis.
And Zach, earnings season coming up pretty quick here. What do you expect? The market, Zach. We're going to be running into this earnings season running pretty hot here.
Yeah, this earnings season is an important one. Especially given how narrow the performance of the S&P 500 has been, really over the last month and a half. So a couple things that we're really paying attention to. One, we're going to get top line good earnings growth, about 9% year over year on a consensus basis. And so broadly speaking, that's healthy for the overall market. It should be healthy too for not just the top of the market, but the rest of the market. But I think what we're really going to be looking into really closely is two things. One is margins. With inflation clearly slowing down on a trend basis, companies that can maintain their margins and pricing power are going to be rewarded by the market, and companies that can't will see underperformance. And so that's one thing that we're going to be focusing on. And the other thing that we're going to be focusing on is just continued enthusiasm around the AI theme. We have a handful of stocks at the top of the index that have been driving us for quite some time, and they are quite expensive. Looked at on many kind of measures across time. And so for us, it's important for the top of the market and the AI related names to continue that beat and raise phenomenon that we have seen, really over the last 5 or 6 quarters. And so those are the two things that we're going to be looking for as earnings season starts next Friday.
Zach, what about a broadening, though, of participation? Are you expecting a greater balance when it comes to earnings growth beyond those tech names?
Yeah, I mean, this is the other thing I think that investors are going to be grappling with throughout this year is that the growth advantage that the top of the market has enjoyed on the average stock in the S&P 500 is set to narrow throughout this year. And some of that's just base effects, and some of that is the fact that we were in a slowdown in kind of the manufacturing part of the economy, which is the broader, more average S&P 500 is more geared towards that as opposed to the tech names at the top of the index. And so, that growth spread is going to be contracting throughout the year. And so how investors handle that is something that we're going to be watching quite aggressively. But broadening out for broadening out's sake, we've never really subscribed to that thesis. I mean, you need to have the macro environment and the fundamental environment aligned to have a kind of a broadening out price action. And so, as we sit here today, we don't think that's going to happen, but that's certainly something that we'll be updating, over the coming weeks.
All right, Zach Hill of Horizon Investments, thanks so much for hopping on with us today.
Thank you.
Well, we are just getting started here on market domination. Coming up, Wedbush's Dan Ives saying that Elon Musk has his mojo back as Tesla shares are once again riding higher today. We're going to speak to the analyst about his latest price target hike on the other side.
And wage growth nears a 3-year low in June. We're going to get economist reaction and take a look at what that means for an already slowing labor market ahead. Stick around, more market domination still to come.
The street is getting more bullish on Tesla on the back of its better than expected second quarter delivery numbers. Wedbush is one of the firms raising its price target on Tesla, now seeing the stock could rally to $300 a share. Joining us now, we want to bring in Dan Ives. He's Wedbush Managing Director and Senior Equity Analyst. So Dan, you're very bullish on Tesla, saying now that the worst is behind it. What gives you the confidence?
I think it's the comeback kid. I mean, this is all now starting to play out for Musk and Tesla. Clearly, look, it's been a tough 6 to 9 months. 2Q, I think, is the turning point, not just from a delivery perspective, but now going into historic robo-taxi day and autonomous. I believe the AI story alone is worth $1 trillion potentially at Tesla.
And Dan, robo-taxi, it's great to see you. It's Josh. I get the excitement there, Dan, but that is that's a long-term play, right? It would be a while before you would expect to see any kind of, meaningful financial contribution from that, right?
Yeah, look, Josh, I think in the next 18 to 24 months, we'll have some form of supervised robo-taxi in certain cities, in my opinion. I think given where China is going on FSD autonomous, I think the technology is getting closer and closer to something that, when you look at the longer-term Tesla story, I've never viewed as an auto company. Disruptive tech, despite some of the issues they've been through from a demand perspective. But take a step back, you're going to have 6, 7, 8 million cars on the road, Teslas, that are now going to have that autonomous FSD. And I think it's very important to understand forest through the trees. This is essentially an AI robotics disruptive play, but yet the bears in their hibernation caves will continue to say it's a car company.
Well, Dan, one of the big issues, though, for Tesla over the last several quarters has been the cars and demand and what they need to do in order to spur that demand. I guess, has that part of the equation, has that part of the story changed at all? Or are we starting to see, or do you think we're going to see a real pickup in EV demand? And what's driving that?
Yeah, I think the price cuts, 98% of that is in the rearview mirror. So I think we've started to turn the corner there from a price cut perspective. Demand stabilized. China headwind, now that becomes a tailwind. I think numbers go higher in the street. And I think you start to now see, it's not just about the robo-taxi day and the start of that vision, but I think now growth returns to the Tesla story. And even though they've been on the outside looking in of that Mag 7 party, I think they start to get back on the dance floor.
And Dan, what about the lower price models on the way? What do you think the price is? How excited do you think investors should be about that?
Yeah, Josh, I think that's going to be key from a volume perspective. I think 28,000 to 30K is sort of where we see that. I think they'll give some hint of that on August 8th, but that's key to the volume game playing out in Tesla. In terms of the broader volume, then it's the software. And then ultimately, it's really the autonomous FSD. That's the sum of the parts to how you start to get to that bull case, $400.
Dan, one of the near-term catalysts that you laid out there is robo-taxi day. And I guess I'm curious, what does Tesla need to announce, or what do you expect Tesla to announce to have this historical moment, as you put it?
Well, I think it's really showing the technology. I mean, this is, because ultimately, the carrot and the stick here is, does Uber, do they partner? In other words, like down the road, is this something where 5-10% of Ubers are actually using autonomous FSD?
Dan, do you think that's likely?
I think it's very likely. And I think it's something where in the next 3 to 5 years, I could see Josh in New Jersey getting into an autonomous Uber with no driver.
Only if you're coming with me, Dan. Only if you're coming with me.
We'll be in the back.
Hey, near term, Dan, also, though, more near term, July 23rd, Q2 results for Tesla. What do you expect there, Dan? What are the metrics you're going to be making a beeline for?
I think the profitability metrics are going to surprise on the upside. I think if you look at the storage, the software piece, higher margin, that's significant, along with some of those tough cuts they've had to make in terms of cost cutting. Profitability preserved. You now start to see a resurgence from a cash flow and EBIT perspective. I think that's also why the stock's rallying here, is that it was sentiment, and we talked about it, the last 3 months, sentiment's so negative. Unless you thought there was something structurally wrong with the story, I think the stock was just due to go higher. And now many of those bears that talked about 100, now I think, we're going toward 250, 300.
On that earnings call, though, Dan, do you also want to hear more about how business is going in China, more color and commentary there?
Well, China is the hearts and lungs of the Tesla story. And that's also why Musk has made some of those trips to Beijing, because that really went from a headwind to a tailwind. Now, I think we're starting to see a mini rebound in China. That's significant in terms of the broader bullish Tesla story. Tesla doesn't go higher without China growth coming back. And I think it's starting.
What about the pressure, though, from domestic players there, just in terms of the competition, the fact that they are able to offer these vehicles at a fraction of the price? Is that going to be something that's going to hold back some of Tesla's growth?
Yeah, look, that's going to continue to be that Game of Thrones battle that Tesla sees domestically in China, BYD, NIO, XPeng, and others. But it's not a zero-sum game. I mean, I believe BYD will be a winner, just like I think Tesla's a winner. I think Tesla as a global winner. But the gold at the end of the rainbow is autonomous FSD. Like if you're playing Tesla here, you're playing for the broader vision. But I would just say, look, everyone viewed NVIDIA just as a chip company a few years ago. Apple is just a smartphone player 4 or 5 years ago. Microsoft is just a software player. Look where we are today. That's why in this AI party, we believe it's only 9 p.m. in a party that goes to 4 a.m. And Tesla will be a part of that.
Dan, it is always great having you on the show, my friend. Have a great 4th.
You too. Thank you.
Paramount shares getting a lift after the company reportedly reaches a preliminary deal to combine with Skydance Media. It's according to the Wall Street Journal. So the drama continues. You knew that, Shauna. You knew it wasn't over. Although it does sound like maybe the drama could be coming to an end. We do have the report. Skydance has reached a preliminary deal to buy Sherry Redstone's National Amusements, merge with Paramount Global, of course, parent of CBS, MTV, and others. Now apparently goes to a special committee of Paramount directors for review. And of course, this follows the collapse of talks between the two last month, but it does sound like what's new here, per reports, again, higher valuation for National Amusements, and importantly, it sounds like stronger language indemnifying the Redstone's company against any kind of litigation that could result from the deal.
Yeah, exactly. And I think what investors are trying to figure out right now and in reaction to this deal is whether or not this really changes the narrative surrounding the investment story with Paramount, now that they do potentially have this deal locked in. And I think that that is very much TBD, to be decided here over the coming weeks and coming months. Barclays was out with a quick note here in reaction to this, warning that it's, quote, not clear if it changes much in regard to the outlook for Paramount stock. They went on to say that after 7 months, the fact that this is the only serious deal right now on the table says a lot about Paramount's strategic choices. So I think when you stack up this deal, what is being reported versus why the talks collapsed this time, maybe a little bit more money was enough to convince Sherry Redstone that this was the right deal to go with. But again, what the future looks like for this company when you're trying to make that investment choice, investment decision, they're just trying to, I guess, evaluate how much is going to change here under Paramount. That's very much to be decided, it seems like.
Yeah, because they make a good point, Barclays, because you look at this media industry and it's under so much pressure here. Streamers trying to reach profitability and traditional DV is shrinking. So you're still trying to figure out how, if the deal does get done, how it kind of addresses some of these bigger structural headwinds.
Yeah, exactly. And I also think this also just points to a conversation that I know you and I have had with so many of these guests over the last several months. And that's just what the consolidation is going to potentially look like within the streaming space. Obviously, lots of talk and focus has been on Paramount over the last 6 or 7 months, but even looking beyond that to some of the other smaller players within the space, how exactly or what's kind of strategic moves they need to make in order to better compete with some of the larger names out there. All right, let's take a look at Constellation Brands posting an earnings beat for its fiscal first quarter, a jump in quarterly profit as its beer business achieves an 8% net sales increase. The beer business certainly a standout within this report. Margins improved at Constellation, better volumes, lower cost, helping that out. Strong demand for new offerings. Our CEO Bill Newlands within this release, obviously very upbeat on these results, and went on to say that this really reinforces the company's significant growth outperformance relative to the entire sector.
You a fan of Modelo? Corona?
I like it, yeah.
Yeah, no. Some of the Liptons, absolutely. Yeah, I was just reading through some of the notes right here, the commentary. Some were saying, Shauna, beer business did better, I guess, than they had kind of forecasted and modeled, even as they know the broader beer industry had been, I guess, kind of weak relatively in the spring. They know, yes, beer comparisons actually do get tougher, though they also pointed out, at least some of these analysts, that the broader industry backdrop seems to be improving.
Yeah, and what's amazing to me is how many of the quote unquote newer drinkers, customers that they were able to attract during the Bud Light boycott, how many of those seem to have stuck with Modelo here? When you take a look at those comparison numbers there, yes, more people have gone back to drinking Bud Light, those sales improving just a bit. But again, the fact that Modelo was able to dethrone Bud Light as a top-selling beer in the U.S. and then retain some of those new customers really tells, I guess, a story just about what that potential growth could continue to look like here in the future.
All right, turn to another one here, Shauna. Novus Bio's phase 3 Parkinson's study showing improvements in cognition after treatment. Here with more is Yahoo Finance's very own Anjali Kamlani. Anj.
That's right, Josh. As you can see, the stock for this company is down today after it surged 119% yesterday on the good news. A little bit of that pullback coming from the point that, while it did improve cognition, that wasn't really the main goal of this drug. It is supposed to treat Parkinson's disease and those that have, an issue with mobility and the like. So the cognition part of it kind of rolls over more into the Alzheimer's sphere, and that's a separate study that the company is pursuing. So that's sort of where you're seeing this pullback coming from. But the good news is that the drug has shown some improvement. The company is still in discussion with the FDA on when they can actually apply to bring this drug to market. So there's no real news on bringing this to the fore just yet. They are looking as far out as October for this conversation, according to information from the call yesterday. So it looks like still kind of a long runway for this drug and this company.
All right, Anj, while we have you, we also want to talk about a different study that's certainly capturing Wall Street's attention today, putting some pressure on the GLP-1 stock, specifically the findings here from a Harvard study. What can you tell us about this?
Yes. Okay. So this is an observational study. So I want to make sure we point that out. And it only looked at semaglutide, which we know are the Novo Nordisk GLP-1 drugs. So this cannot be broadly associated with Eli Lilly's drugs as well. The reason for the study was just to look at an association with a type of vision loss with use of the GLP-1s. Now, if you recall in the past, we've heard many different side effects of these GLP-1s over the years. One of them we recall really starkly was suicide ideation. They found, the FDA and the EU both found no links with the drug. So this is just another one of those things, and that was the point, the researchers said, was just to let people know there has been something identified related possibly to this drug and to call for further studies as well. So that's sort of where we stand on that right now.
All right, so maybe some of the downward pressure that we're seeing in the stock is just a blip here today. All right, Anj, thanks so much. Well, investors digesting a fresh batch of labor data ahead of the key jobs report on Friday. The private sector adding less jobs than expected in the month of June, while continuing jobless claims rising for a 9th week in a row. Here with more on what this means for the labor market and the Fed, we want to bring in Interactive Brokers senior economist Jose Torres. Jose, it's great to see you here. So we had the latest jobs number really pointing to the fact that maybe we are seeing this cooling happening within the jobs market. We also had the services PMI print out a couple of hours ago, pointing to maybe some weakness there. I'm curious how you're looking at this and really what this tells us ultimately maybe about the Fed's next move or how the Fed is evaluating this data.
Great to be here, Shauna. Thanks for having me. Well, I think that the labor market is slowing, but corporate balance sheets are really robust and employers are under no pressure to begin to lay off employees. However, continuing claims just went up to a 32-month high. And as far as ISM services is concerned, consumer spending has been really erratic in certain months. We saw the same result in April, an abrupt weakening. Then in May, we recovered back into expansion territory, only to dwindle again. So consumer spending has been erratic, particularly amongst lower and middle end income consumers. Now, financial markets have also supported consumer spending. So I think that the labor market and rising paychecks alongside financial markets being so robust, that's really supported consumer spending. As far as the loosening in financial conditions that's occurring, I think that's going to support inflationary pressures further later this year. And it's going to make it quite difficult for the Fed to cut in September, although we are going to have 2 consecutive cool inflation reports. We got the one from May. The one from June next week is also going to be cool. But then that leaves us with July and August before the September meeting, which I think is going to come in a little hot, particularly as oil prices are at a 2-month high on heightening geopolitical tensions.
So Jose, when do you think you actually hit that the Fed's 2% target?
I think we're going to hit the Fed's 2% target somewhere in 2026. Fed Chair Powell was asked about it. He didn't think that we would hit it this year or next year. In fact, when we consider the disinflation that occurred last year in the second half, now those base effects become unfavorable into the second half of this year. So we're going to actually see core PCE start to tick higher. And if you look at the dots, the summary of economic projections from the Fed, they're expecting core PCE to finish the year around 2.8%. If we do get a little bumps on the road, we could be at 2.9% or 3%.
Jose, I think we spend so much of our time talking about when the Fed is going to cut, exactly what that short-term trajectory or timeline really looks like. But when you take a look at the longer term, right, there's lots of questions about what is going to be that new normal, what exactly the longer-term neutral rate is. And you had the Fed's John Williams out defending the R-star model. Not exactly a surprise there, but I'm curious, do you think, how much has the economy changed post-COVID? And when you take a look at that longer-term neutral rate, maybe what do you expect that to look like?
Well, Shauna, I think we're going to be in the high 3s and the low 4s. I've been telling folks that the short end of the curve is particularly attractive because I don't think the Fed has much room to cut without reigniting inflationary pressures. When we consider the shift from globalization to regionalization, alongside deficit financing, which is not just occurring here in the States, it's a phenomenon going on all around the world, that's really propelling inflationary pressures. In fact, we've been seeing a move in the long end of the curve and 10-year yield, you were talking about it earlier, heading up to 4.5%, even with economic data that's been surprising to the downside. And I think that's the market telling you that at the longer end of the curve, there are going to be some concerns. So again, I guess the question is, if the long end of the curve is going to be, call it at the bottom 3.5 perhaps, then how low can the Fed funds rate go? We have to stay above 3, certainly, I think, in this new economy.
I'm curious, Jose, just given your overall impressions of the economy and the labor market, get your views too on the consumer. Where do you think the consumer is now and where are they headed?
Well, Josh, wealthy consumers are doing great. They have several homes. They're appreciating in value. Their 401ks are going up. Their investment portfolios are doing great. Middle and lower income consumers, however, aren't doing phenomenal. They're doing all right. They're hanging in there. They have jobs. Their wages are growing, but it's not proportionate with how well the wealthier folks are doing. So that's where we're starting to see some significant cracks. Y'all were talking about it earlier with restaurant sales and transactions. We saw it today in ISM services. And I think that's really what's going on with the lower and middle end consumer. They're managing their budgets like a light switch. Okay, we spent a lot in May. Let's slow it down in June, and then we'll come back in July. So that's really, but as that erraticness begins to increase, I become concerned that maybe we really are at the end of the consumer spending expansion.
Jose, always great to have you on the show. Thanks so much for joining us today.
My pleasure. Thank you.
And coming up, we are breaking down the best ways to position your portfolio in the software sector for today's investor playbook. Stay tuned. Much more market domination after this.
Less than an hour until the closing bell on Wall Street. Let's check in on the major averages right now. We're still looking at green for the S&P and the Nasdaq. You got the S&P and the Nasdaq both on track to close at new record highs today. Flipping over, though, to the Dow, under just a bit of pressure, falling below the flat line here over the last hour or so. Taking a look at some of the sector action, why we are seeing that outperformance play out within the Nasdaq. Some of that having to do, actually, with the semi stocks, with the chip stocks there outperforming. You've got NVIDIA back in the green today. Some buying action going on there, up nearly 4%. You also got Taiwan Semiconductors, Broadcom amongst the outperformers there. ARM up just around 3.5%. When you take a look more broadly speaking at that sector action beyond tech and beyond some of those chip makers, you've also got consumer discretionary among the outperformers there, up just about 0.6%, and materials also among the leaders there. On the flip side, healthcare still the underperformer today, off just around 1%. Let's kick it over to Jared Blickery, who's taking a closer look at some of the moves that we're seeing in the crypto market today. Jared?
That's right, Shauna. Seeing kind of a red wall here behind me. We see Bitcoin down just over 2.5%. Ethereum up down over 3%. Solana down 4%. Binance token down 3%. So some slightly outsized movement. I guess you could qualify it as that. But overall, let me just show you a chart of Bitcoin. I'm going to come year to date, and I'm just going to highlight once again this long consolidation pattern here. Very interesting because now we're at the lower end here. And let me put some candlesticks on so you can see more precisely. 60,000 is a very important level. We have dipped below it at least one time in kind of a major way, and that was a fake out. Led people to think maybe there was going to be a breakdown, but then we went right back up and tested the upper end of the range. And this is something that's been frustrating traders for several months now. Is this the time that the range is finally broken? Well, just be on alert for a false breakdown once again, but usually those don't last more than a day or two. So if we start heading down and for more than 2 or 3 days, probably going to head towards that next lower consolidation level. That could be as low as 45,000 by the time things shake out. And we know with crypto that prices can move very quickly. Let me just go over Ethereum technicals real quick. This is another 2-year chart. Looks somewhat similar to Bitcoin, but this price action here is actually much steeper. This year-to-date price action is actually quite a volatile mix, but you can see Ethereum in the middle of that range. I'll hit Solana's too. Interesting, it's been in the news lately. Van Eck filed for a spot Solana ETF, and kind of similar to Ethereum, not at any particularly interesting or encouraging level right now, but tends towards the bottom end of that trading range. So really watching Bitcoin here, see if it holds 60,000.
All right, thank you, Jared. Let's get to our call of the day. Loop Capital is raising its price target on Reddit from $60 to $75. The note highlighting the OpenAI licensing deal. So, Shauna, Loop Capital, they like Reddit. They still like Reddit. They reiterate their buy. They do raise their revenue estimates for this year and next year. OpenAI, remember, is going to license Reddit's data, become a Reddit advertising partner. Reddit, in turn, is going to bring OpenAI features to Reddit. So the team at Loop, obviously, they clearly like the sound of all that.
They do. They raise their revenue estimate here by $15 million and $20 million for the year and for next year. Talking about the boost that this licensing deal, they see that really having on Reddit's business here going forward. They also talked about the fact that Reddit reintroduced ads on its discussion threads, its fastest growing ad format here, and they had not yet adjusted their model for that newest enhancement there. So because of all that, they're seeing more of a bullish outlook here for Reddit. I also thought it was interesting just in terms of the potential growth areas that Loop Capital mentioned going forward. One of those areas that they highlighted would be growing the user economy, helping enable users to earn money on the Reddit platform. That could include marketplace opportunities, that sort of thing. They use that as an example as one of those catalysts. And then also the lockup period for shares. 82% of shares subject to the lockup ending, which will likely, they say, likely be close to August 9th, assuming that those two second quarter earnings are at the same cadence as their Q1 report. So again, maybe that could be a catalyst here for shares as well.
Yep. All right, moving on. Software stocks could see some major upside ahead. That's according to some promising technical signs. Taking off concerns of AI headwinds. We're taking a look at how to navigate that trade in the Yahoo Finance playbook. And joining us now, Victor Cassell, senior analyst macro and equity strategy at Seaport Research Partners. Victor, it's good to see you. So you seem to suggest your software has some legs here, Victor. What we're seeing in these names, more than just kind of a short-term rebound?
Yeah, Josh, Shauna, thank you for having me. Exactly that. It's legs meaning more than one step here. The sentiment has been entirely overdone. There was a period in the first half of the year where the software models were under pressure, or at least the perception of investors was that AI would disintermediate many of these seat-based models, and some of these seat-based models would be shifting to consumption. We think that sentiment has been overdone, and the proof points for that are coming through Salesforce, through Adobe. And we've also had, through that sort of consternation of the first half, you've had an expectations reset. So expectations went really low for software. They're very high for semiconductors. And now as you get these data points, whether it's operational efficiencies of how software companies are employing AI or how they're monetizing AI, and in particular, Adobe was kind of our big proof point or inflection point for that. We think this AI story is rather early on the software side. And when you go into the back half of the year, you have budget flush, you have the fiscal year end for the government. There's a bit of a seasonal aspect here. And lastly, to your prior guest point about the softening of the economic data points, you have lower yields, which tilts defensively for the market, and software within technology is a fantastic defensive traditionally.
And Victor, just given some of the technical standpoints that you're closely watching here, I guess when you lay out that more bullish case for software stocks, what does that upside potentially look like from here?
Yeah, I think you kind of, if you look at the range that you can consolidate, which, call it for the proxy that we're using here, the IGV, the software ETF, if you have a consolidation range over the last 6 to 9, 12 months of 10 to 15%, you generally tend to exit that and have momentum coming out of that. Our biggest thing, as with AI, which is pattern recognition, technicals are as well, but we're seeing a lot of familiar reversal patterns in software stocks in particular, whether it's their moving averages, whether it's their formations. And in particular on IGV, it's the reversal formation that really caught our attention, the prior consolidation that kind of springboards to the upside.
Victor, there's been a lot of time and money and effort poured into AI. Is part of your call here that you think, when it comes to software names in the next 12 months or so, investors will have kind of greater clarity about who the winners and laggards are?
I guess that's what makes a market. Some believe yes, some believe no. Part of the disintermediation is, do you have access as a small company to AI models, and can you build a product off of that? Or do you go with the reliable? And I think the market will probably shift towards the reliable. If you look at what's working in the market, its market cap, its size. If you're an enterprise, and I think this was the proof point coming out of Adobe, if you're a serious enterprise customer embracing AI, you want to go with your most trusted people. Salesforce is your number one customer front end CRM platform. That's where all the data is. Their data cloud was up massively. From a data perspective, it was up 40%. From a transactional perspective, it was up 200% all on year. The point being is, these are my trusted partners. I'm a real enterprise. I've got to embrace a transformational change. Am I going to do it with a startup that might get access to these tools on AWS or Google Cloud or Azure? Or do I go with the guys that I already know? I think it's with the guys that you already know. And coming out of Adobe, it was like, oh, do these startups eat their business? And Adobe came back and told you, not only are we growing customers, we're retaining customers. And I think that's really the unwind of negative sentiment in software for the back half of the year that we're bullish on.
All right, Victor, great to get your insight. Thanks so much for joining us here today. Happy 4th.
Hey, happy Independence Day. Thanks, Josh. Thanks, Shauna.
All right, well, mortgage rates ticking up this week, though still hovering just below 7%. We will discuss home builder names next on Market Domination.
Mortgage rates ticking up this week with the 30-year fixed at 6.86%. Once rates eventually ease and buyers enter the market, that could be beneficial for home builders in more ways than one. And joining us now is RJ Osley, Chief Market Strategist at Toggle AI, a platform that provides AI-derived insights from market data. RJ, it's good to have you on the show. So in broad strokes, RJ, what I understand is you're using AI to make investment recommendations. And right now, based on that, home builders, you say, are looking pretty attractive?
Yes. I think home builders in 2023, they had a strong year. 2024 has not been nearly as kind to them, with the ITB ETF down, underperforming about 20% versus the broader market. But there are some bright spots. I think, two key things which are screening well. Chairman Powell has sort of indicated that the next Fed action will be a cut, even if we don't know when that might be. And the market is really pricing 2 cuts by the end of the year. As you noted, mortgage rates, while they're off highs, that's been really sort of stymieing home builders. Another key piece for home builders are that lumber, a key input, is down about 20 to 30% since March. So we're starting to see that tide turn this year where we might be able to really see an uptick in home builders.
RJ, talk to us a little bit more about the methodology here. You're using AI to see trends to really help you ultimately pick some of those opportunities within this space. I guess more specifically, what are those key metrics that you're closely watching? And when it comes to home builders, how much, it seems like that very much has been the story of the last couple of months. So I guess what has changed? Is it just the fact that we're getting closer maybe now to that rate cut story?
I think certainly getting close to the rate cut story is a big piece of it. I think, we connect often macroeconomic data and microeconomic data and stocks, and we analyze both structured and unstructured. And what you're starting to see is that on the macro side, you've seen this sort of lock-in of mortgages where people who have had very low rates on their mortgages being unwilling to move. And you're starting to see, even with the wage increases and wage pressures, hopefully the mortgage rates coming down sort of helps that problem of job mobility and people moving and help with the volume of housing that's turning over. The other piece is that you're seeing in a lot of the transcripts, earnings, a lot of these big names within the home builders that have lending arms in addition to just building. They're really the sort of winners in this high rate environment. Exactly. As you pulled up names like D.R. Horton, $40 billion name, because they can sort of win on both sides, right? They're giving you the mortgage and they're making money on the construction itself. It really often helps with some of their margins and really helps sort of continue the business in a way that smaller names like Beazer at the bottom might be under a bit more pressure.
RJ, you mentioned some big name home builders. You also have some big name backers for your firm. I just want to ask you about it. You got Stan Druckenmiller, I see, Thomas Petterfy. How did you connect with those two and how they helped your business?
Yeah, it's a great question. We've had tremendous support from Interactive Brokers and from Stan Druckenmiller and the Duquesne family office. I think there's really demand across the street to extract insights from data, right? A lot of people have access to data, but the really hard thing is processing it, being able to understand it, and really figuring out how do I save time, right? And really a lot of those problems are, where should I spend my time? What parts of the market are interesting? And where should I be investing or investigating further? And that framework that we put together really resonated with Stan himself, as well as with the Interactive Brokers founder.
All right, RJ, very interesting, great insight there. Thanks so much for joining us here on Yahoo Finance. Have a great weekend.
Thank you, you too.
We are also watching shares of Intuitive Machines, which is under pressure after a big rally on Tuesday. Cantor Fitzgerald reiterating its overweight rating on the stock as investors wait on its second lunar mission. Earlier this year, Intuitive Machines made history, becoming the first commercial lander to successfully land on the moon's surface. In our series next, Akiko Fujita explored the space economy with an inside look at Firefly Aerospace. Take a look.
repair nets.
This is to make sure that no particles are left behind.
Right.
What's going to happen to the lander? My hair
It
falls
just
in there.
spontaneously combust.
I don't want to risk the mission.
Excel, we don't want that.
Yeah, there's a lot of Excels back here.
Come on in. So this is our clean room. This is where we do all of the assembly of our spacecraft. And you'll see right over here is Blue Ghost Mission 1.
The Blue Ghost lander is third in line to attempt a moon landing this year. Developed by Firefly Aerospace, the company's part of a new generation of upstarts seeking commercial success in a place few have gone successfully. Firefly is driving a mission armed with $112 million from NASA. Its goal? To develop a reliable delivery vehicle to the lunar surface.
One of the things that is a little bit different and unique about CLIPS missions is that we are taking a little bit more risk with each mission, but it gives us more shots on goal.
It's the new playbook in the space economy, driven by Elon Musk and SpaceX.
The missions that we're seeing right now are costing fractions of what they would have likely cost had they been run by NASA.
1/10 of the cost, according to the World Economic Forum. That's fueling private competition, accelerating production times, and increasing launch counts.
We're learning from our experiences with our commercial partners. So it's a whole different way of doing the space program.
A program looking to stay ahead in the next phase of a global space race, crewed missions to the moon. This is what's next in the new space economy.
We're getting ready. Okay. So they're chilling in the engine right now. Last little bit.
Oh my God, that is incredible! They say everything is bigger in Texas. And at Firefly's sprawling 200-acre rocket ranch, these daily engine tests are just a small part of the company's operations.
This is our first stage of that Alpha rocket. The second stage is actually on our test stand.
The mission here is to build an end-to-end space transportation company, with each vehicle manufactured and assembled in-house.
We launch, we land, and we orbit, and we're unique in that regard. There aren't many organizations out there that would say they do all three of those things as a purpose.
Firefly doesn't just launch rockets and landers. It builds orbital vehicles that stay in orbit, ready to repair, refuel, and relocate satellites. The company's successfully launched 3 rockets into orbit so far.
We'll have a lot of the same avionics on this spacecraft that we use for rockets. These right here are cold gas thrusters, and so those are the same ones that we use on rockets.
That reuse of materials is part of a push to drive costs down. In 2023, the company doubled the size of its facilities here to automate a big part of its production.
This AFP machine lets us build our Alpha launch vehicle structures in just 7 days and our medium launch vehicles in 30 days, which is a huge improvement over months with the more typical technology of laser-guided hand placement manufacturing.
9 times faster and 7 times cheaper, according to Firefly. It's one example of just how quickly commercial space companies are transforming a $630 billion industry. In this new space economy, it's the private firms driving the missions, with NASA as the customer.
How much of what Firefly is doing today, being able to own the full stack, is because of what SpaceX has proven out?
SpaceX and their presence created a bridge where we went from almost entirely government-funded and owned missions to a commercial infrastructure and a thought process that redefined how do we move with speed to get things built. If that hadn't been done, well, there's no way we could have taken inside of the timeframes we did.
That has saved the U.S. government a lot of money by getting a commercial business involved that is not only doing this for NASA, but is now a launcher across the board for commercial and other government payloads. And it's spawning off all kinds of new businesses.
That lower cost and ability to move quickly has transformed the business of space. Today, companies like SpaceX are launching every 34 hours. That's nearly 260 launches per year. The investments are pouring in. The space economy is now forecast to reach $1.8 trillion in roughly a decade. Growth has largely been limited to launch systems and satellites, but NASA's leaning on these private companies to take them even further. The agency's awarded $2.6 billion in grants to develop a low-cost transportation system to the moon to take NASA's research to the lunar surface.
We can survey the south pole of the moon before our astronauts ever get there.
And liftoff of the first United Launch Alliance Vulcan rocket.
We saw 2 attempts already, one Astrobotic that had a valve problem, and then we saw Intuitive Machines.
We can confirm, without a doubt, as our equipment is on the surface of the moon.
Had a soft landing on the South Pole. It sent back all kinds of data.
Firefly is next in line. Its Blue Ghost lander is set to launch in the second half of 2024 on board a SpaceX rocket.
We have 10 different payloads on this mission. We have everything from a device that samples lunar regolith to something that's testing GPS capability on the way to the moon, as well as a drill that's going to drill into the surface.
That mission alone will cost roughly $100 million, according to the company. Back in the 1960s, NASA paid roughly $660 million for similar missions when adjusted for inflation.
3, 2, 1. Boosters in ignition. And liftoff of Artemis 1.
It's all laying the groundwork for the Artemis missions, NASA's program to return astronauts to the moon. The first crewed flight in partnership with Lockheed Martin and Boeing is now set for 2025 after a delay.
What is NASA trying to accomplish this time around?
We want to go to Mars and beyond. We need to learn to live in a very hostile environment, to be able to supply ourselves, to invent, to create, in order for us to be able to send humans all the way to Mars and ultimately beyond.
NASA faces plenty of competition globally. More than 100 lunar missions are planned by government and private companies this decade, according to the European Space Agency. China is the biggest competitor. It's aiming to land its own astronauts on the moon by 2030.
Why is it important for the U.S. to be first, particularly in the South Pole?
I think that since it's very clear that China has announced that they are going and intend to go to the South Pole of the moon, they've said that they're going to set up a research station. All that's good, but I think from past experience with China on the face of the earth, I think it's not beyond the pale that China would suddenly say, we're here, you stay out. And so that's why I think we're in a space race. To get there to the very promising South Pole of the moon. Why? Because we think there's water there. And if there's water in abundance, then there is rocket fuel. And that gives us a gas station on the South Pole.
Commercial revenues already make up roughly 80% of the global space economy today. That share is expected to get even bigger, raising concerns about relying too much on the private sector.
In the past, NASA very much has been a civil organization that works very closely with the Department of Defense. And many of the technologies that go into space are controlled by the US federal government. The risk is that you start to put more and more of that into industry, and you're now beholden to the expertise and experience of industry, kind of in the same way that you are with a lot of the aerospace and defense industry as it exists today, where you have a few set of very powerful primes who are great at what they do, and they develop some of the most amazing advanced technologies out there. But the government no longer owns and controls a lot of those assets.
Martinez also says there's an added risk to publicly traded companies. Intuitive Machines stock tripled in value in the lead up to its moon landing, but it fell more than 30% once shareholders learned the lander had tipped over, preventing its full mission from being completed.
This industry is very difficult, very speculative, and there's a lot of risk in it. And it is hard to go at the pace that you need to go and to take some of the risks that you need to take if you're focused on near-term value for shareholders.
Firefly's remaining private for now, adding speed to its equation. In 2023, the company launched a satellite into orbit 27 hours after receiving the order, shattering the previous response time of 21 days.
I just keep thinking that, what you hear from commercial companies is we're more nimble, we can move quicker, we're more aggressive. Is safety being compromised in all of this?
No, you can't lose missions. You can't endanger people. There is no business plan that survives any amount of speed and agility if you're hurting people and you're not protecting a customer's investment.
Companies are exploring opportunities beyond unmanned missions to the moon. Startups Astrolab and Intuitive Machines are building their own vehicles with NASA funding to shuttle Artemis astronauts around the lunar surface. Firefly's racing ahead with its own plans. The company's now building a medium-sized rocket with Northrop Grumman so it can launch its lunar lander without the help of SpaceX. And it's moving into lunar missions independent of NASA.
We believe there's enough demand out there right now for us to schedule a Firefly run lunar mission using that platform behind us with 100% commercial payloads on it. Now,
no NASA funding.
No NASA funding, but isn't it interesting? NASA might be one of those tenants. NASA might say, hey, great, glad you're running that mission. We'd like a spot. And that's where this needs to go. Commercial industry, much like we plug into the wall and say there's electricity there, commercial industry needs to be running that transit. And the government, instead of being the prime contract driver, will utilize that capacity. There's most definitely enough demand on the commercial side to tell Firefly, the indicators are there, let's announce that mission.
How important is it to get it right the first time?
Nobody is limiting our capability to, hey, it'll be great if we just make an attempt. We're gonna put that lander down exactly where it needs to go on the Mare Crisium on the surface of the moon. That's the mission. That's what we signed up to. That's where everybody's focus is. We're in these to participate in these missions now, learn everything we can so that when the commercial lunar market evolves, we're ready then to scale it. I think our focus, though, is making sure that no matter how many winners and losers there are, Firefly's one of the winners, and high degree of confidence that's going to be true.
It has been a rough week for President Biden amid questions about his ability to serve another term following his debate performance last week. And now new reports of donors backing out, and who could replace him are surfacing. For more on what's next, we want to bring in Yahoo Finance's Rick Newman. So Rick, where do things stand right now at this minute?
Well, where they stand at this minute won't be the same as where they stand in the next minute. So I guess I shouldn't spend too much time on this. But the New York Times story you referred to is from a close ally and donor to Biden. They did not identify who it was. I have no idea who it was, who said to the New York Times, or the New York Times got word that Biden has acknowledged to this person that, yes, he may have to leave the race if he cannot turn around the sinking poll numbers and all the other problems he's been having since that terrible debate from last Thursday. So I see two things in here. Number one, this was a leak to the New York Times, and whoever was leaking it to the New York Times may have been doing that to put pressure on Biden to withdraw. So if this is a sign that perhaps even Biden's inner circle, as well as some of the outer circles, are starting to say it's time for him to go and suggesting that he knows it himself, that could intensify the pressure on him. Separately, there was a Reuters poll that came out today, actually represented a little bit of good news for Biden. It showed that Biden has actually improved in his standing against Trump on a nationwide basis. In that poll, Biden improved by a couple of points. He and Trump are tied in that poll. But first of all, that's not the type of poll that matters. The polls that matter are the ones in 6 or 7 swing states, not the national polls. And meanwhile, there are some other polls that show the opposite, that Biden is losing ground. And I think the next several days over the July 4th weekend, there's a lot that could happen. We're probably going to see more polls, get a better idea of how Biden is really faring after the debate. He's supposed to do an interview live with ABC News on Friday. I assume George Stephanopoulos is going to ask him all the questions that are on people's minds. Was it really jet lag? How could it be jet lag more than a week after you got back from your trip to Europe? Are you aware that people think you're not completely competent and so forth? So that'll be a chance to see how Biden handles it. And by the time by the time this segment ends, Shauna, something else could have popped. So who knows?
Rick, I'm also just interested in the process. Meaning, let's say Biden does step down, releases the delegates. Then what happens, Rick?
Well, if Biden willingly steps down, that's not so bad for Democrats. Then first of all, it depends. Does Biden endorse somebody? Kamala Harris, the current vice president, she immediately becomes the front runner, and I think she becomes the front runner by a lot. So there's this thing going on now that people are jokingly calling the fantasy football of the Democratic presidential campaign, where everybody's just putting together their dream ticket. So somebody suggested, what if Kamala Harris runs with Barack Obama as the vice presidential candidate? Not going to happen. There are all these other combinations that not going to happen. But what will probably happen is there will be a ticket with Kamala Harris at the top, and perhaps somebody new and interesting as her running mate. And then the challenge for Kamala Harris is, can she overcome all the doubts that surrounded her after she had a very poor presidential campaign in 2020? And now, remember, she only made it part of the way through the Democratic primaries and dropped out pretty early. She just ran a lackluster campaign. So people kind of think, well, it would probably be the same time around. I'm not so sure. I think she would get a period of time, a honeymoon period, if you will, to reset. We let voters figure out how much has she learned during the last 4 years. What have 4 years in the White House and other parts of the Biden administration helped her learn? Does she have more stature? Does she present herself differently? So that's what I would look for. But that is several, news cycles away, I think. But who knows? Maybe we'll be talking about this 15 minutes from now.
Right. All right, we'll bring you back for sure, Rick. Thank you for joining us. Appreciate it.
You guys.
President Biden and former President Trump disagree on most things, of course, but there's at least one topic they can find common ground on: tariffs. In 2018, Trump began placing heavy tariffs on many Chinese goods, and when Biden moved into the White House, he kept many of them in place. Trump has promised even more extreme tariffs if he wins a second term. Joining us now is Ishwar Prasad, Cornell University professor and author of The Future of Money, How the Digital Revolution is Transforming Currencies and Finance. Ishwar, it's good to see you. So as we noted there, listen, election front and center and tariffs are front and center, Ishwar. You know, Biden and Trump, they do have different approaches, but they both have embraced tariffs. I'm just interested, Ishwar, to begin there, whether when you think about tariffs, you know, is that, in your opinion, is that smart, effective policy?
I've just returned from a trip to China, and I can tell you that the Chinese government is certainly poised for having to deal with tariffs under either a second Biden or other Democratic administration and Trump administration. Now, there is going to be a change, though, in terms of the tactics and strategy if there was to be a Trump administration in place, probably much higher tariffs. But the Biden administration has actually been quite effective in terms of limiting technology transfers, limiting China's access to chips, which matters a lot more to China right now, essentially because they're trying to move up the value-added chain, upgrade their technology sector. But the reality that China faces right now is that their recent recovery has been led by the production side rather than the consumption side, and they need export markets. So I think tariffs are coming from the U.S. and perhaps from other Chinese trading partners as well.
So Ishwar, to the extent that you can, I'm curious what you can share just about the sentiment of Chinese officials at this point towards the U.S. And if we do see this continued escalation of tariffs, what exactly the U.S.-China relationship could potentially look like here in the coming years?
I think there is a baseline right now that is going to be very difficult to go below, meaning that it's going to be difficult to de-escalate tensions because in the U.S. there is very little political or economic payoff to doing so. But the reality, of course, is that if one limits imports from China, that does have effects on U.S. inflation, that does have effects in terms of limiting access to a lot of products that China is now marketing to a very significant extent, where it has a large part of the world capacity. Now, China cannot afford to lose access completely to U.S. and other Western markets. As I mentioned right now, exports have been powering their growth, and at least in the short term, they certainly need export markets, and they need the foreign technology as well. So they're trying to play nice to the extent they can, trying to limit their retaliation to what they consider proportionate retaliation. But I don't think it's going to get any much better in terms of the relationship between the two countries in the coming years.
And Ishwar, as you said, you just got back from China. I'm interested in your take on the Chinese economy, Ishwar. Not just today, but where do you think it is 6 months from now, 12 months from now? Because we speak to a number of investors and money managers, Ishwar, and there is a fair amount of obvious skepticism there.
There are both cyclical and structural factors that are a problem for China right now. As I mentioned earlier, what China has been able to do, which a command economy is very good at doing, is stoking production. So what they've done in the last couple of years is try to fuel credit to the parts of the economy that they're traditionally relying on, which are the large state-owned enterprises. The problem is that those are not very good at generating employment growth. And more importantly, the Chinese government faces a problem right now. There are lots of underlying structural problems, weaknesses in the financial system, weakening demographics, and there is a sense of economic malaise overall. And I get the feeling that both households and private businesses in China feel that the government does not have a very clear policy strategy, either in terms of boosting short-term growth or in terms of dealing with these longer-term issues. Private enterprises feel that the government has become much more hostile. So we've seen household consumption and private investment not doing very well. And that creates a real imbalance in the Chinese economy. If consumption stays weak and if private investment does not pick up, that's going to make both employment and productivity growth much harder for them to sustain. So some difficult times ahead, both in the short run and the medium term for the Chinese economy.
Ishwar, going back to what you just said a couple of minutes ago there when you were talking about inflation, some of the inflationary pressures that we could see as a result of tariffs, I'm curious if you can elaborate on that just a little bit here. If we do see that 10% blanket tariff that President Trump has floated in a couple of interviews, or even escalating that up to 60% tariffs specifically on Chinese goods, what's the ultimate impact do you see to Americans, and then that global fallout, what that could potentially look like?
So there are two elements here, Shauna. One, of course, is the direct inflationary impact. If you think about, low-skill, low-wage manufacturing, which China has been very good at, there are attempts to find other countries from which the U.S. could import, but there aren't any that can provide those things at scale. But China is a very important part of global supply chains for a variety of other goods as well, including electronics, including solar panels and the sort of things that are very important for the green transition in the U.S. So in each of these, while the U.S. looks to build domestic capacity or looks for alternative sources of supply, the fact that there are going to be rising tariffs on China will almost certainly affect U.S. prices. But the underlying fact here is that China is trying to move into those industries. I think of them as new technology industries, green energy, electric vehicles, and so on, which are precisely the industries that the U.S. is counting on for its own manufacturing revival. So that, I think, is a structural problem in this relationship right now. It used to be seen as the economic relationship being a positive-sum game, but given that both countries are now relying on exactly the same sort of industries for the future of their manufacturing sectors, it's becoming seen as a zero-sum game between the two countries.
Ishwar, super interesting conversation. Thanks so much for helping us walk through it. Have a great 4th.
Thank you. You too.
Coming up, a look at some of the big themes behind today's market moves. More market domination over time coming up.
Wall Street, it's looking to maintain momentum after the S&P 500 and Nasdaq hit fresh records. For more on how strategists are viewing this market's performance, we want to bring in who better to ask? The head of news for Yahoo Finance, Miles Udland. Miles, as we lead up to the shortened, or as we do have the shortened holiday week, lead up to the 4th.
The market better be closing in 8 minutes. Right?
And the market also better be closing in record highs. We'll see whether or not that still stands. But strategists are trying to figure out where the heck do we go next?
Yeah, I mean, it's the time of year, right? The 6-month mark, you'll get a lot of Wall Street strategists updating their targets. Josh Schaefer has covered over the last few weeks all the notes we've seen. And this week, 3 interesting developments. So the first one happened yesterday. Lori Calvasina and her team over at RBC raising their price target to 5,700 from 5,300.
Great guest.
And I thought that a lot of what they had in the note was really interesting in, I don't want to call it begrudgingly raising their price target, but they're
cautiously optimistic.
Yeah, I mean, the team was not out there screaming like you have to buy the S&P. I think it was more of a resignation, like this market appears to be grinding higher despite all these metrics that may not be the most constructive things
Sometimes,
in the world.
Miles, it sort of sounds
like
like when you hear people like saying, analysts saying, yes, still buy NVIDIA, it's like, well, I'm not pounding the table here. I'm just saying you got to.
Well, and NVIDIA, of course, is kind of the reason the S&P is going higher, and I think that is frustrating not only investors, it's frustrating strategists, because now we have this situation where we refer to the S&P 500, the benchmark index, 500 of the biggest companies. What a great representation of the balance of American business. And what, a third of the entire index's gains are one stock that sells chips? So like now you're a Wall Street strategist, I guess you've got to care about what NVIDIA says next quarter about 2027 demand for its Blackwell, processing system. As if these guys know anything about that. We're all like, well, hopefully those people know.
Hopefully there's an analyst like just a couple desks down, hopefully next time, who can explain, all right, Blackwell.
Well, yeah, I mean, I think that helps, but you're like, hey, your stock's up 600% the last 3 quarters. What am I supposed to do with this? Like the S&P 500 grinds its way on average to that 10%-ish total return over time. And as a Wall Street strategist, when you are looking top down, what is the S&P 500 as a group going to earn? And what's the multiple that's appropriate for those earnings? It becomes a very challenging exercise when so much of that success is tied up, sure, in NVIDIA as one stock, but really AI as one theme. The rest of the index is looking at earnings that are flat, basically.
So then, I was going to let you not to jump on
no,
you
go,
here.
go
but
for it, Shannon. Go
so
for it.
because of that, right?
Yes.
It's a very complex picture right now. It's been all about AI. We certainly have seen these price targets, at least comparing what we have right now versus what we had 6 or 7 months ago, a totally different picture. Now strategists, some of them are kind of just throwing up their hands saying, hey, we don't really see the value in having a year-end S&P target.
Yeah, on the personnel side, 2 interesting developments today. So we'll start with Michael Kantrowitz over at Piper Sandler, just pushing out a note within the last couple of hours that he's not going to provide coverage of the S&P 500. He said he'll have more on this in a strategy video he sends to clients on Friday. But basically his view is that the index is not kind of what we think it is. It's not what we say it is. We call it, again, the benchmark index. It's not really serving as a benchmark. And what's always interesting in strategist notes, the sell side notes that we get here in the media, is that a lot of this will be informed by the conversations that these strategists have with their clients on the buy side. And my read through, and maybe we can have Kantrowitz on at some point to talk about this, is that he's having a lot of conversations with money managers who are like, I don't want to hear about the S&P anymore. I'm not thinking about the S&P. I get it. I'm underweight NVIDIA. Sorry, but I run whatever my portfolio is.
And this is the
I'm
line.
long, short,
He says this, Miles. He said, talking about the S&P 500, the market, to communicate investment insights to institutional investors has, he says, become an exercise in futility.
Yeah. So, you're sitting there with some, pension fund, and they have X amount allocated to equities. Within that, they have X to US, et cetera, et cetera. Yeah, obviously these guys don't have 20% of their portfolio in AI names. Obviously they're underperforming. We don't need to talk about it anymore. Let's talk about what do we have, how can we make money, and just saying, hey, the S&P's up a lot. Did you guys see that one? Like, yeah, I mean, I got it. I got it. So.
And then we have Klanovic leaving JP Morgan.
Marco Klanovic leaving JP Morgan. And I think, this one came out from our former colleague, Alexandra Semenova, now over at Bloomberg this morning. And immediately everyone's reaction on Twitter was, well, that's the top. Because when you have a strategist like Klanovic, who's been bearish, who is now, going to be changing, he's going to be leaving the firm. We've got, someone on his team stepping into that role over at JP Morgan. It's not hard to kind of add it up. They were tired of hearing about this guy saying the market was going to go down when it went up every day. So maybe the time is now.
All right, Miles, great stuff. Thanks so much for hopping on with us. Happy 4th of July.
Happy 4th of July.
Any plans?
We're going to go to the July 4th parade in Chatham.
Chatham, New Jersey. Maybe I'll see you there, Miles.
Listen, hopefully soon we can sit here and do a real Chatham talk.
We've got the closing bell coming up on the other side. We'll be right back. That's the closing bell on Wall Street on this shortened trading day. And time now for market domination overtime. Let's see where the major averages ended up here for the day. We've got Jared Blickery also standing by with a closer look at some of the movement that we have been seeing. But another record-setting day here on the street. We've got the Nasdaq closing up just around 0.9%. Taking a look at the S&P 500, that's also at another record here, closing up about 0.5%. We also take a look at some strength even within the Russell 2000, closing up just about nearly 0.2% here to the upside. Taking a look at some of that sector action, why we're seeing some gains, at least here for the S&P and the Nasdaq, and some of that having to do with NVIDIA. When you think about the biggest contributor here, at least to the S&P's gains, you look at NVIDIA closing up just around 4.5%. When you take a look at that 3-day chart, some of that momentum that we have seen for NVIDIA. Not, I guess, too much of a different of a picture here as you take a look at what has certainly been a volatile couple of trading days here for NVIDIA over the last several days. But again, closing up just above $128 a share on a sector basis. Still looking at a bit of a mixed picture. Jared, over to you.
Yes, and I'll note that XLK was the only sector, that's tech sector, that closed at a record high. And also we've been seeing some strength here today in materials and also consumer discretionary. And I would remind people that consumer discretionary just had a big breakout yesterday. The two biggest components, Tesla and Amazon closed down today, down about 1.2%. But I want to take a look at Tesla, up 6.5% over these last 3 days, up basically 25%. That is a huge gain. And when you take a look at the longer term picture, you can see, well, it still hasn't climbed all the way up to the midpoint quite yet of this very extended trading range over the last 5 years, but it's quickly getting there. I think someplace around 260 or so probably due for a pause, if not a little bit before. But let's also take a look at some of the other leaders that we've seen emerge today. It was a great day for chip stocks, also solar bouncing back, cannabis stocks, Chinese stocks, disruption, so that would be unprofitable tech. And let's just dig into a couple of those. Here are the ARC components, boosted mainly by Tesla, but we're also seeing some green by Beam Therapeutics, up 5%. China, I mentioned, was also in the green today. Here we got Tcom, that's Trip.com, up 4%, Alibaba up 2.5%, Baidu up 3.5%. So another area that's been under pressure, kind of bouncing back. But all in all, I just bring it to the fact that July, the first 10 trading days of July, the most bullish of the year when you take into consideration the beginning of a month or an end of a month. So especially going into this holiday shortened week, not a lot of surprise to see the bulls in charge here. We'll have to see what comes Friday, which is kind of an odd day for us with the employment situation report falling after this market holiday.
Thank you, Jared. Stocks closing mixed on this holiday shortened trading day with the S&P hitting its 33rd record high of the year. For more on what this means for investors entering the second half, going to bring in Tyler Ellegard, portfolio manager at Gradient Investments. So Tyler, it's good to see you. As my colleague Jared was just saying there, bulls have been in charge, S&P hitting its 33rd record high of the year. What do you make of that, Tyler? What are you telling your clients about it? Do you think the good times continue?
Yeah, I mean, I think generally speaking, good times could continue, but the back half of this year certainly going to be choppy. Obviously, we're getting a contentious election coming up. Who knows who the candidates are officially going to be on the Democratic side after the news today. So it's definitely going to be a choppy second half. But if you look historically, statistically speaking, second half on a election year, presidential election year, and on a year that's been this strong, you typically get decent performance in the back half. But I think from a broader perspective, certainly start taking some profits on these names that have done well and try and diversify the portfolio a little bit. We don't need to risk everything on betting it all on NVIDIA right now. Obviously, it's done very well, but I think you get a happier client with a more diversified portfolio from the top six.
So what are you diversifying into there, Tyler?
Yeah, I think energy is a good option right now. We like Schlumberger, or SLB as they've kind of changed their name a little bit, or Suncor Energy, a Canadian name. Those are a couple. You could look at some of the industrial side. So from the infrastructure bill, CRH, a cement company, is certainly one that we like. But that doesn't say that we're taking everything off the table from these mega caps, right? We still like the Googles, we still like Meta, and we still like Amazon. We still think there's room to run, but we may just be a little bit underweight on the NVIDIAs and Apples and Microsofts right now.
What about healthcare, Tyler? I see that in my notes here. That's also a sector you're bullish on?
We are. Generally speaking, most of the healthcare play right now has been towards GLP-1s, at least for the last, call it, year and a half. I do think there's some opportunity outside of those names in more of the diabetes space. Dexcom being one of them is kind of my top pick right now. Their ability to reach from just the U.S. market into international markets and the new products that they're bringing on, I think this company has a pretty strong growth trajectory in front of them. And plenty of tailwinds behind them. So I think from a healthcare side, that would be the name that I would go with.
Tyler, when you take a look at how calm the market's been, really, we've had this absence of volatility now for quite some time. Is that going to change with earnings season? Do you think that could potentially introduce maybe this next wave of volatility leading up to then, obviously, the election?
I do. Certainly, investors are going to be paying attention to Q2 and how those earnings go. Q4 of last year, Q1 of this year has been strong so far. Earnings revisions have actually been positive. But I think more of the focus is going to be on the election and what those policies are going to tell us. Just like Monday, for example, interest rates spiked on potential policy actions of either party. So I think, yes, Q2 is going to be important, but I think sentiment and focus is going to be more towards the election and how and diving deep into the policies of either candidate and how that's really going to affect the market for the next 6 months to a year.
Tyler, we got through this almost entire interview. We didn't even mention the Fed, which in itself is kind of interesting. I mean, does you, as an investor, how close are you monitoring the Fed? Whether the Fed cuts this year, do you think that's critical to whether the market can keep moving higher?
Yeah, look, I think as we entered the year, the consensus was 6 to 7. We initially thought, based on our expectations, was 1 to 2. Data was strong, growth was strong, Fed was holding tight. Their commentary didn't suggest they were going to cut. Now we've kind of pivoted a little bit, but we still think we might get one or no cut at all. I know the Fed likes to be apolitical, but I would say that a cut in front of a contentious election that could be construed as a political action, I don't think the Fed wants to get involved in that. So I think your best bet is probably around December. And despite all that, data has still remained strong on the economic front. So there really isn't any reason for them to make any cuts at this point, unless if we do start to see more deterioration through September and October.
Tyler, when you take a look at some of the expectations here for inflation, we have seen a bit of this disinflationary trend or disinflation trend. Powell was commenting on it earlier this week out of Portugal, saying that he has been encouraged by that progress. What do you think that last mile as the Fed works to get back to that 2% goal? Is that something that's going to be very tough, take a long time? I guess, how are you evaluating that as you lay out some of those opportunities that you're finding within the market?
It's certainly going to be tough for them to get to that 2%, and certainly don't expect it to be at 2% by the end of this year, and Paul has even said that. So for us, what's important is looking at, obviously, housing data is one of the stickier components, but then you also do get some headwinds from last year's disinflation and from some of the consumer durables. They had some negative prints last year. And so I think there could be some headwinds that could pop up this year. So I think, generally speaking, you need housing to come down, or slow, I should say, as well as some of the energy prices and food prices. I think that's going to be the biggest headwind and keeping inflation this sticky. So it's going to be a challenge, and I don't expect them to get to that 2% target anytime this year.
All right, Tyler Ellegard, great to have you. Thanks so much for talking with us here. All right, we got the latest reading on the housing market. Mortgage rates higher for the first time in 5 weeks. We want to bring in Yahoo Finance's Rebecca Chen joining us now with the details. Hey, Rebecca.
Hey, Shauna. We have seen mortgage rate, the fixed 30-year average rate, increase about 9 basis points this week, according to Freddie Mac. Now, this is the first time since May that rate have increased, and also the first time in over 4 weeks that it went up. We've seen rates hover around that 7% mark for a while now. And one housing expert actually said this has helped inventory to come back to the market. And the reason is because with a more stabilized mortgage rate, more homeowners are willing to list their home by giving up their lower mortgage rate. And the reason is because they're getting a lot more used to the higher rate environment that we are seeing today. What has been happening is, as Americans, move on with their life, maybe they have a new baby, maybe they need a new school district, it's getting to a time where some people have to move and put that inventory on the market. Now, from the home buyer side, we have yet to see a return of demand at the activity on the mortgage activity. Mortgage application is still very low according to the latest statistics, but housing experts are saying that as we see mortgage rate stabilize or even decline, we will see more inventory on the market, and in turn that will help with the housing prices and bring buyers back.
Rebecca, thank you. Appreciate it. Have a great 4th. With a rich history dating back to the 19th century, Eli Lilly has faced struggles and successes, but a booming market cap has quickly turned it into the biggest pharmaceutical brand in the world. Let's dive into Lilly's biggest moments with Beyond the Ticker.
With a rich history dating back to the 19th century, Eli Lilly has faced struggles and successes. But a booming market cap has quickly turned it into the biggest pharmaceutical brand in the world. Let's dive into Lilly's biggest moments with Beyond the Ticker. The company was founded in 1876 by Colonel Eli Lilly, a pharmaceutical chemist and Union Army veteran. Lilly experienced huge growth before and after World War I, including the expansion of its Indianapolis facility. In 1923, the company began selling Illatin to treat diabetes, the world's first commercial insulin product. Then in 1952, Lilly became a publicly traded company on the New York Stock Exchange. In 1971, Lilly acquired cosmetic brand Elizabeth Arden for $38 million, eventually turning it into a financial success. It sold Arden to Fabergé for $657 million in 1987. Fast forward to 2009, when Lilly faced a fine of over $1.4 billion, the largest in U.S. history, for illegally marketing its blockbuster mood disorder drug Zyprexa. It wasn't until 2022 that Lilly hit the jackpot with tirzepatide, a new type of GLP-1 product sold as Mounjaro for type 2 diabetes. It began competing with Novo Nordisk's Ozempic. Zepbound, the same formula as Mounjaro, was approved for obesity in 2023 and began competing with Novo's Wegovy. The tirzepatide drugs have spiked Lilly's stock by nearly 100% in the past year. In 2024, Lilly continues to reach all-time highs and is currently the biggest healthcare company in the world, with a market cap of well over $800 billion. Wall Street projects the GLP-1s alone will net Lilly $13 billion this year. It's why Lilly is on track to make history as the first trillion-dollar healthcare company.
Bidding big on Made in America, Walmart launching a line of t-shirts from direct-to-consumer brand American Giant just in time for the 4th of July holiday. And it's a move to also combat the rise of fast fashion. Joining us now is Bayard Winthrop. He is American Giant's founder and CEO. Bayard, it's great to have you, and congratulations on this partnership that you just reached with Walmart. I'm curious what kind of insight you can give us just in terms of the ability, I guess, the ease at which you have been able to 100% manufacture your items within the U.S. and some of the biggest challenges maybe that you have had faced running up here into ultimately reaching this significant partnership here with Walmart.
Well, thanks for having me on, Shauna. You know, the U.S. Textile base has been under a lot of pressure over the last 35 years as so much of offshoring has hit that industry particularly hard. And like a lot of other offshore manufacturing bases, it is increasingly dependent on orders that are 1 month out, 2 months out, with a real inability to invest longer term in the automation and innovation and job retraining and hiring that's required to stay competitive on an international basis. And so, though this partnership with Walmart, never easy to hit that kind of volume that Walmart requires. It was a real breakthrough moment, I think, for our brand and for textiles more broadly, when you have a partner like Walmart stepping up to a long-term commitment and a volume commitment that allows the supply chain partners to really rethink the way they're thinking about producing apparel in the United States again. So it's an important moment, I think, for the industry and for us as a brand.
And Bayard, I guess 2 questions for me. I'm just curious. First, just why, it was so important, Bayard, to you to make the product here in America. Why was that such a core value to you, a core mission? And secondly, I'm just curious, Bayard, kind of just the economics of your business. I mean, how much more does it cost you to make the product here than it would if you did like so many of your rivals did and just made it overseas?
Well, it costs more, Josh, and I would argue it should. I mean, I think one of the real benefits about manufacturing domestically is when you make things here, you do it within the constraints of the American system, which includes human rights protections, environmental protections, child labor protections, living wages, things that I think we all as Americans really appreciate. And there's a bit of an inconsistency in my judgment when we allow our biggest brands to manufacture overseas, getting around many of those constraints while we hold our domestic facilities to those high standards. We got to pick a lane, one or the other. And I felt the impact of that over the last 35 years was hitting middle-class working Americans really hard. And if we have, as many of us know, middle-class wages have been stagnant over the last 35 years, and that dynamic doesn't end well for America broadly. And I think we have to start investing again into the communities that are making things here, so we begin to give good opportunities to those towns, those cities that want to have good, viable, and dignified work. And so that was a real founding mission for our brand. But maybe to the root of your question, it costs more to make things in the United States, and that put most of American Giant's pricing in the premium end of the market, and it really was out of reach for a lot of working Americans that need to have access to good quality products, ideally good quality American-made products at prices that make sense for them. And this Walmart partnership really has broken into that tier in a way that I had begun to wonder if it was going to be possible for us to do that without that kind of commitment and volume from a big partner like Walmart. So it opens up a whole new consumer segment for us, and it really has caused us to, I think, really rethink and reimagine what a domestic textile capability can be. And hopefully that challenge begins to make its way into the big brands in the U.S.
Bayard, have you heard interest from other big brands
in the U.S. to similarly try to take on?
Bayard, sorry to cut you off there. You dropped for a second on the mic. But my question is, you certainly obviously now have this partnership with Walmart. Are you having any sort of conversations, seeing some interest from some of the other larger brands at this point?
I think the larger brands and retailers have, as a generalized statement, have tried to be a part of the solution here. And I think this now points a way forward for them to join the conversation. So I'll leave it there. But I think there's a lot of interest. But there has been confusion about how to do it, and I think this is a good example of how to get it done. And so hopefully that's going to encourage others to join in.
Bayard, have you been able to find? It's still a tight labor market. It's hard for employers really to find the labor that they need. Have you been able to hire the workers that you need to expand at the rate at which you are hoping to do?
Yeah, it's a good question. I mean, I think we manufacture typically in rural and urban communities that need work. And so we've been pretty lucky in that regard, that there's a lot of talented workers that are looking for good, durable jobs by and large, we've been able to hire the people and the talent that we need. So I think there's lots of communities, maybe it doesn't show up in the labor numbers, but a lot of communities that need good employers there. And where textiles are domiciled, it's often in those communities that need that work. And so we've had good success in that regard.
Byron, I'm curious what's next for your company. Do you want to stay private, or would you be considering testing the public markets at some point?
It's not something I spend a lot of time thinking about, other than to say, I think as a private entity, you're allowed to make decisions that are longer term in nature. And I think that's pretty fundamental with an American manufactured footprint, that you're not beholden to core